It's been a pretty impressive cooling of the labor market throughout the course of this year.
We are expecting the inflation numbers to continue to come down.
Part of what's driving our inflation today is lack of labor supply.
I'm not sure that we've seen all the pain that this increase in interest rates will cause to the economy yet.
I believe that the soft landing scenario is the worst case scenario.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Three-day losing streak on the S&P 500, having a little look at day 4. A line from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market negative here by 0.25% on the S&P 500 in about 3 hours and 25 minutes. President Biden touching down in New Delhi, TK, going into the G20. And right on cue, last week it was Commerce Secretary Gina Raimondo going over to China, and then we got this new Huawei Mate 60, Tom. Well, I can tell you we've got a Mate 60 Pro Plus out of Huawei. That drops just as the president arrives at the G20 in India.
Somebody on Twitter sent me a video, and it was in a mall somewhere in Asia, and it showed the Huawei store packed, everybody looking at the new toy, and the guy literally turned around across the mall and looked at the Apple store, which is empty. I guess that's sort of the mood right now. Will that mood change at the Apple meeting coming up? But the Huawei thing is Lisa, before we were coming on the show, mentioned, it's complex. It's the product. What's it mean for Apple? The defense characteristics and all that. It's a jumble. It's a toxic brew.
A toxic brew. Bramo, let's talk about that brew. Toxic. 2 days, Apple down more than 6%. Pretty brutal stuff.
Especially when it equals $190 billion of market valuation, just giving you a sense of the scope of what that kind of loss means. Just taking a bigger picture step, we don't understand exactly what the meaning of this pro level is. And I think that we really heard that from the U.S. government saying we have to investigate this further. But 2 things. Number one, what does this mean for further sanctions, further potential U.S. action if it seems like their current measures aren't working? And 2, is this a shift away from China supporting Apple despite the fact that it employs millions of people in the
Those
country?
are unknowns. I mean, we don't know. I'm going to go with Dan Ives, who's more than enthusiastic. I thought the interview yesterday was Anastasia Amoroso, who just boldly said, stepping in by the dips. I take a huge issue with this media fixation on 200 gazillion with Apple. They're down 8% off $3 trillion. It's what's called a correction. Granted, everybody owns a stock. There's no one breathing. Vetbill has
Vetbill owns Apple.
Vetbill owns Apple, too much of it. He lost his AirPods. But the answer here is it's a correction of a bellwether stock.
Let's work through it with purpose. In about 3 hours, I'll catch up with Dan Ives, by the way, of Wedbush.
Oh,
going into
your
that
other
launch
property, not on our property.
Next week.
Thank you.
What have we learned in the last 48 hours or so from the Journal, from our reporting here at Bloomberg?
Yeah.
That we are starting to see bans at the government level, from state agencies and potentially to state firms. So, Tom, this is the question I've got for you, and maybe you can help me answer it. Do you think there's a big difference between what the Communist Party thinks is good for their government and what the Communist Party thinks is good for their people? Now, the reason I ask that question is not that I think we're going to get a ban from Apple anytime soon across the whole country. That's not what I'm suggesting. I'm just suggesting we're talking about a communist state who's made a decision that something is not good for employees of their government. Now, Tom, why do you think there's going to be a big difference between what they think is good for their government and what they think is good for their people in a communist country?
I read every word of Mark Gurman published last night. I looked at the time, actually. I believe it was 8:58 p.m. I put it out on Twitter, folks. Mark Gurman, definitive here. And he said exactly what you said, John, and then he alluded to where it becomes not cool. And going back to Mr. Jobs and his aesthetic of Apple, that's the big fear. One day they wake up and the toy's not cool. Right now, I don't think they're there, but that's the Chinese risk.
Totally on the same page. Does the mood sour going into this launch next week? And we'll talk about that from both sides of the argument. Your equity market right now on the S&P 500, negative by 0.2%, just a little bit softer. Yields basically unchanged here, Lisa. 423.83 on the euro. We had a little look at 106 in the last 24 hours against the dollar right now, just about unchanged, Bramo, 107.03.
It's amazing to see that dollar strength today. As you did mention, John, we are going to see President Biden head to New Delhi ahead of that G20 meeting, a bilateral meeting between President Biden and Prime Minister Minister Narendra Modi at 10:05 a.m. Very focused on this relationship, especially with Apple very much in the forefront. Is there some sort of deal to encourage production to move to India? Today, Fed Speak continues. It includes Fed Vice Chair for Supervision Michael Barr at 9 a.m., San Francisco Fed President Mary Daly at 11 a.m. Really, how do they frame nuance at a time where anything that isn't hawkish is viewed as edifying the idea of cuts and holding, and it's supporting rallies in the markets? And today, the economic data, kind of light. It includes household change in net worth at 12 noon and consumer credit at 3 p.m. at a time where delinquencies are starting to creep up. And this is what I also am focused on in some of the commentary from retailers. They're starting to see people failing to pay their bills on the margins. When does it become a concern? It still is coming off incredibly low levels. It is nothing like it was even 2 years ago.
That's a great chart on radio. It's just simple, Lisa. Your wonderful chart. We're not back to pre-pandemic delinquencies. I mean, that's the heart of the matter.
You're in a good mood this morning.
I am in a good mood. The kids are back in school.
You've been nice to Lisa.
They're accounted for,
Is that your barometer?
Lisa's in shock.
I'm not sure what to do with this.
It's like, we had a great panel yesterday. Mike McKee killed it with John Williams.
Yes. Monetary policy's in a good place, I'm told.
It's in a good place.
By the New York
I'm in a
Fed
good
president.
place. John Williams is in a good place.
Okay,
I'm in a good place.
we're all in a good place then. Jonathan Stubbs, equity strategist at Berenberg, joins us right now.
Help us.
Jonathan, forgive me for the soundtrack. Equities are stretched, expensive and narrow. Jonathan, that was you in the last few weeks or so. If you believe they're stretched, expensive and narrow, am I right to guess that you're not buying the first sign of a pullback?
I think you've got to be brave and have very good purpose and reason to do so. And you'd have to back a surge in sort of liquidity around the world, dollar liquidity. I think that's very hard to see. Or you'd have to really back a strong recovery in earnings next year. I think there are reasons against that. So, yeah, we think there's more downside risk here as we go through the next few months. We're underweight technology, as per your conversation, for a number of reasons, not least because the US tech sector is trading above a 60% PE relative to global equities. And when that's happened over the last 30 years, your median return owning US tech is minus 20% relative versus global equities, and your win ratio is just 10%. So the tables look stacked against global equities, US in particular, and tech at this point.
Jonathan, how do you interpret the phrase a correction? It seems to me we've almost forgotten what a correction is, how much a correction is, and how we should behave given a correction. Have we lost our path there?
I think we've lost our path in many ways. We're in a brave new world, as we call it, and there's lots of sort of shifting sands. I mean, pretty much every investment decision has politics, geopolitics involved, just as one element. But yeah, we've always sort of seen a pullback as sort of 5%, maybe a little bit more, a correction, 10, 20%, and beyond that, you're into sort of bear market territory. These markets could easily be right for certainly a pullback, and maybe more than that. As I say, to turn it around and to be really constructive on equities, you need to back a liquidity surge going into next year. That only comes from a macro shock, which is negative first, or you need to back a return to strong earnings. And one issue I have with that is all economists are expecting nominal GDP growth in major economies not to accelerate into next year, but to slow by over 200 basis points. That's the main feed into top line growth. So I think there are earnings headwinds ahead, and therefore liquidity, earnings, both are not there, in my view, to support this very strong move up. And therefore, I think we have these sort of risks skewing markets sort of moves to the downside as we go through the next sort of quarter or so.
There's a lot to unpack there. I want to just touch on what you mentioned with geopolitics suddenly becoming part of a conversation in a more meaningful way than you've ever seen before. How are you characterizing that in risk models, in quantitative terms?
Yeah, I think it's challenging. We've had a market backdrop for over 40 years, since the early 80s, which has been globalization, and the global economy has been getting closer and closer, the sort of the wonders of just in time, etc. And a variety of forces are changing that, and we appear to have this very sort of this visible, invisible conflict between the West and the global South, the expanding BRICS group, and that comes into every investment decision now. It's driving the outperformance of tech this year, for example, because it's forcing the CHIPS Act, your side of the pond. It's driving fiscal policy to underpin growth. It's driving, economist forecasts. It's driving every element of what we think about. How do you sort of hedge that is pretty difficult. But I think we bring it into our sort of thinking in terms of risk. Right now, we overlay all of our models, and we see quite an attractive trade and portfolio skew towards energy away from technology, and geopolitics is also part of that, because we're seeing geopolitical risk extending, and importantly, energy and tech have broken away from 10-year treasuries over the last 6 months. And if there's some reconnection there, energy gets further support in the months ahead.
There's a tension here as to the why behind energy and the rally that we've seen there. On one hand, it could be tied to global growth, which supports a more supportive backdrop than the one that you just portrayed heading into early next year, certainly for earnings and GDP expansion in developed nations. And then on the other hand, it could be the geopolitics that really caused the rise, and it ends up being disinflationary and suppressive of growth. Which is it that's really fueling your bet on energy?
Well, we bring fundamentals in here as well, because if I'm looking at the 5 biggest European energy names, or some of the US energy names, but the 5 biggest European ones, they're close to net cash, so the balance sheets are super solid, and the average free cash flow yield of the 5 biggest is 15%. So these are incredible machines. They just happen to be called energy stocks. So if they get some support from geopolitical dynamics, shifting sands, oil prices, the macro, they're very well set to perform. They're very cheap. They look cheap against industrials. They look incredibly cheap against tech, historically so in terms of the gaps. And we think at a time where markets are stretched, it's a good place for investors to raise exposure to.
Jonathan Stubbs, the heart of the matter, as you brilliantly said 4 questions ago, is we've got a nominal GDP challenge to the top line. How do you bring that over to the risk to free cash flow? How do you get from reduced nominal GDP over to a free cash flow study for 2025?
Yeah, I think this is critical. I mean, I've been talking about this all year, and it's been one of my sort of handbrakes, if you like, as I've gone through this year. If you look at top line growth, sales growth in the US, 21, 22, both double digit, maybe even a bit higher post COVID. Europe even more so. And this year, top line growth is slowing pretty much to nothing. And analysts are expecting top line growth to accelerate into next year, whereas economists are expecting that top line feed to slow significantly. Just to be clear, in every US recovery, we've seen a 5 percentage point positive delta in nominal growth. As we go into next year, I know it's not a normal cycle, but nominal growth in the US is expected to fall in terms of growth terms by more than 2%. So I think there are challenges here for earnings, there are challenges that read across onto cash flow as well. And that makes it quite tough to look at markets today and to really put significant weight on upside risk as we go into next year. Some industries better positioned for cash than others, some have better cash flow cushions, but you bring tech back into this. Remember, this is the first time in 15 years where the technology sector does not offer investors a free cash flow premium relative to risk-free, i.e. the free cash flow yield you can get out of the tech sector today is lower than US interest rates. That's the first time we've been there in 15 years. So if you're just taking yield, you take the risk-free, not tech-free cash flow.
Jonathan Stubbs, game changer. Thank you, sir. Jonathan Stubbs there of Berenberg. Just to pick up on Apple, the stock down in the pre-market by just 0.2%. Last couple of days, quite difficult 2-day loss of more than 6%. Just got an alert on my iPhone. Software update available tonight. You know what that means? It's like Operation Slowdown, Bramo.
Oh, yeah.
Going into the new release.
I've gotten the same one.
Next week.
Yeah.
You're going to use it?
I always delay it as long as possible because it's
Do
a
they
new
really
interface.
do that?
Well, I don't know if it's exactly
But
tied
that's
to that.
rumored. It's in the zeitgeist. They do that,
There
right?
was actually reported, and I did this because of you, John.
Thank you,
raised
Bramo.
this, and I was thinking to myself, okay, this is just another thing that's made up. It's a conspiracy. No, it was true. They actually had lawsuits against them in terms of slowing down their operating system. Is it to slow it down? I don't like the whole new interface.
I'm not sure if they are doing it anymore, just for the
There was a lawsuit.
just for the record.
Probably stopped it.
Yeah, maybe. Shout out to Coco Gauff. Can we do that?
Yeah.
US Open finalists.
And they're playing until
Very
like
cool.
1 a.m. I looked last night, and they're up, like, it goes forever.
I can't believe she's still 19, which is like crazy. We've been talking about it for years.
It's exciting.
Just
Yeah.
amazing. Congratulations. Going to be a great weekend for tennis here in New York City. From New York, good morning.
also see China's growth as slowing over time. That said, China has quite a bit of policy space to address these challenges. So we're monitoring the situation. I don't see it as having very significant direct impact on the United States.
That was Treasury Secretary Janet Yellen speaking in New Delhi as world leaders gather in India for the G20 summit. About 3 hours from now, the president touching down in that nation for the G20 going into the weekend. From New York City this morning, good morning to you all. Pulling back over the last 3 days on the S&P, about to make it day 4. Equity futures on the S&P 500 negative here by a couple of tenths of 1% on the S&P. Apple, where the pain has been, Apple down just a touch. It's negative 0.1%. No real drama there. In the bond market, yields basically unchanged. On a 10-year here, Tom, 4.24. In the FX market, nothing about this dollar is unchanged. 8 consecutive weeks of dollar strength and a euro clinging to 107. 107.01 this morning.
I like the clinging nails where we are now, looking across equities, bonds, currencies, commodities. I have no clue what the correlations are right now, but I do take your point, John, that foreign exchange is where I want to look. The fact is, on a boring Friday, it's not, because I got DXY at 105. I mean, just the summed idea with the Torsten Slok and Christina Campany and Lee Farage yesterday and our wonderful FX panel here at Bloomberg, this is the heart of the matter. The dollar call is the indicator of all these dynamics we have into Q4.
And there is a split going into the ECB next week, by the way. The team here at Bloomberg putting together the survey. Allow me to share that with you. A Bloomberg survey shows an almost even split between those anticipating a 10th consecutive hike next Thursday and those anticipating a hawkish pause. So, Tom, right down the middle, going into the ECB next Thursday.
We're in a good place. That's what
According
John
to
Williams would say.
New York Fed President John Williams, yeah. I'm not sure
place.
anyone in the ECB can say we're in a good
Nobody
place. Yeah, not quite the same.
In a good place is the President of the United States. There is a symbolism for Air Force One to land in Germany on a refuel to India. He will land there, John, what is it, 9 o'clock hour?
9:25, I'm told, yeah, 9:25 Eastern Time.
For a G20 meeting fraught with the geopolitical turmoil of the moment. We are so advantaged in India to have Menaka Doshi with us, with Bloomberg, really experienced on the economics, the fabric of India as they greet the elite in New Delhi. Menaka, thank you so much for joining us this morning. What will that meeting be of President Biden with Mr. Modi scheduled for today? What will be, obviously there'll be the smiles and the greeting, but what will be the underlying tension and topic of a Biden-Modi meeting?
Well, I imagine the first thing they'll be talking about is China and China's no-show here in India. And by that, I mean the absence of Chinese President Xi Jinping. They will talk about both the optics of that and the politics of that and how that will impact many of the issues that both leaders are hoping to bring to consensus at this G20 meeting. Let's not forget, Prime Minister Modi had what the Indian government terms as a very successful visit to the U.S. not a long time ago. And this is the 4th visit, I believe, for Treasury Secretary Janet Yellen to India in just this calendar year, and the year isn't over yet. So I suspect the second point that they'll talk about is the strengthening relationship between the two countries, despite the differences that they have, for instance, on the Russia-Ukraine war.
Well, on the war in Ukraine, and the tension point in the West may be India's relationship with Mr. Putin right now. Rumor has it Mr. Putin will not be in attendance. Mr. Xi will not be in attendance. What would you presume will be the way Mr. Biden, or for that matter, Mr. Modi, approach the delicacies of Russia and the war?
India has walked a very fine line, Tom, through the course of the last 2 years as this war is unfolded in wanting to be able to protect its national, geopolitical and commercial interests. So the Indian government has made no bones about wanting to buy oil from Russia at discounted prices, because the high prices we saw in the energy market, which, by the way, have come back over the course of the last few weeks, are debilitating to India that rely on imports imported crude. So I think the balancing of commercial interests with the geopolitical requirements of the G7 nations who have wanted India to denounce the war in Ukraine, but the government here has refused to use very harsh words and offered instead to mediate between the two warring countries, in a sense will also be a topic of conversation as the two leaders meet this evening. It's delicate, but they've traversed this distance before, and they'll do it again this evening.
How much, Manaka, will the Indian government and business leaders really petition the U.S. to become the #1 producer, taking the place of China? We've seen this with Apple very much in the forefront, and news reports that they are shifting some production to India. How much are Indian leaders going to be active in the recruitment of this?
They're going to be very active, and I suspect this is the one area where there will be no differences between the two sides. Many U.S. corporations are keen to diversify their supply chain, the China +1 strategy, as it's called, and India is very keen to benefit from that. You cited the Apple example, and I think both governments are working to see if there are other such opportunities that the U.S. corporations and the Indian government can avail of. Let's not forget this G20 summit is a precursor of sort for Prime Minister Modi, who will seek re-election next year for the third time, and he hopes to win. And so he wants to come out of this summit looking strong, not just from the point of view of bringing all these global leaders together, but bagging some key decisions that benefit the economy. This is the world's most populous country, growing at the fastest rate of any large economy, but we need jobs. And for that, we need manufacturing. And I suspect Prime Minister Modi hopes to end this summit with some key announcements to that effect.
Manaka, thank you. Going into the G20 with an absent President Xi Jinping on some of the tension between India and China. Let's throw Apple into that conversation as well. This came from Citi a little bit earlier this morning, still constructive on the stock. This quote right here, TK. China is about 20% of total iPhones. However, India, with 1.5 billion population and around 5% middle class, is the bigger incremental opportunity for Apple in our view. How quickly the bullish thesis changes. That's from Citi, Tom, on India and on this Apple stock.
It's been there for my lifetime. I mean, I'm going to take it back to John Kenneth Galbraith as ambassador for John F. Kennedy, which was in my youth, very much younger. And it's not that it's been an enigma, but it's like, okay, when are we going? I read McKinsey reports that say, okay, what's the catalyst? When are we going? And maybe the catalyst for in India that people have hoped for is not from India, but for China messing it up, which maybe we're seeing right now.
Well, just on the latest on China as well, and on the new Huawei phone, this is what the team over at Citi had to say about that. They believe the Mate 60's technology is still 2 or 3 years behind iPhone with limited production capacity. So there's 2 points there that I think are really important.
Yeah.
One is the tech, and 2 is the production capacity,
Totally
Tom.
agree. Yeah.
Can they meet the demand in China to really rival what Apple might produce over there with the unveiling of the new iPhone in about a week's time?
The labor component is critical, and frankly, I think it's critical for the hope of American manufacturing as well. We've got all these dreams of rekindling manufacturing here, but do we have the labor component down to get that done?
What this does to me is it says maybe China is not there yet. But to both of your points earlier, there is a major sentiment shift. It's been 6 months since Tim Cook came out and said that he has a symbiotic relationship with China. It's not looking so symbiotic right now. It's looking very different. There has been a tone shift. So is this basically the warning shot until China gets the technology to actually compete with Apple? Hey, Apple, maybe move more of your production elsewhere and try to really tap into the growth areas in other places.
Or is an 8, 9, 10% correction here, on my chart, perfectly down to the long-term moving average of Apple? Is it the mother of all corrections and opportunity into, say, the next 2 or 3 years, if you believe that they're going to do something September 12th, like sell me more iPhones?
They're going to send you more iPhones.
I'm listening to Ives and Anastasia Amoroso, and I'm saying, okay, what am I missing? There's all this hysteria out there. I get it.
Sure.
It may be done. It may be over. But how many times have I heard this?
Many times.
With Apple, like uncountable
I would ask
times.
this, though. We mentioned the diplomat, Tim Cook. He's been phenomenal at navigating the tension between the US and China without getting into too much trouble. If Apple's at the crosshairs of this now, what about everybody else, TK? If Apple's finding themselves in trouble, and Tim Cook has done a phenomenal job of navigating this, what about everybody else?
My single determinant to China, and I may be wrong on this, I'm speaking as an amateur, is foreign direct investment into China. That's the thermometer, the barometer for me.
One of our favourites up next, Steve Major of HSBC from New York City. This is Bloomberg. I think we're attempting to break the heat wave in New York City today. Is that breaking later, Tom?
Yeah, last
into
day.
Tomorrow?
Yeah, huge thunderstorms
cool.
north of New York last night. Really spectacular. But, yeah, I think we break it today.
So sticky.
Yeah.
Humidity in September, yeah. We'd call that summer, you know, TK.
Yeah, Rob Carolyn said it's not that unusual, but it's just the weight of it off of a horrific summer in America for heat, like in Europe.
Yeah, there's your weather check. Equities look like this on the S&P 500. Doesn't get much better than that.
We do it
We're
in
negative
Celsius.
on the S&P. We're down here by about 0.1%, down 0.2% on the Nasdaq. Tough few days for the S&P 500. Three-day loss, about to become 4, if this is anything to go by on the S&P over that period. Down not even 1.5%. So, Tom, we'll drain the drama from that conversation just for now. But Apple is where the pain has been. That stock in 2 days down more than 6%.
Mark Gurman Publishing, I put that out on Twitter, definitive on Apple. That's a good summary for everybody waking up this morning.
Let's turn to the bond market, Tom. 2-year, 10-year, 30-year. 10-year right now, 4.24.23. Yields basically unchanged. I have to say, some real conflict in the data. Claims back to the lowest levels we've seen going back to February. Much better ISM. And then you look at the anecdotal stuff, you look at the beige book, and it just screams slowdown. Soft patch coming for the US. A question we've asked in the last week or so, how much weight should you put on each data point at the moment? So that's bonds, 10-year 4.24, TK 2-year 4.94.
We're in a good place.
We're in a good place. According to John Williams at the New York Fed.
We're in a good place.
We're in a good place.
He said we're restrictive, though. I thought that was interesting. I mean, he's like Dominic Constant. He's saying we're there.
Quiet period. Kicks off tomorrow. No more Fed speak.
Oh, really?
Yeah.
Joy to the world.
So all of this Fed speak is going into the quiet period before the Federal Reserve decision on the 20th. I want to finish with foreign exchange. 8 consecutive weeks of dollar strength. Just phenomenal. The euro holding on to 107. 107.01. Just about positive here, Tom, by 0.05%.
It makes Lisa's trips, you know, it's good. She's got a strong dollar. She travels around the world.
Where's Bramo going next?
I don't know.
Yeah, you tell me.
She's working longitudinally west.
Europe in September is usually nice, Lisa. A little bit cooler.
Not a,
Sun's less severe.
All right,
That's
thank
nice.
you. I'm going to London. I'm going to London in a couple of weeks.
We're all going to London in a couple of weeks.
That's true.
That will feel like fall. We're going to come from like 30-something here in New York down to 16, 17 if you're lucky in
No
London.
one in American TV does Celsius like John Ferro.
What would you like it in? Fahrenheit?
We do Fahrenheit, that's fine.
Yeah,
You know,
so unique.
We drive on the right side of the road.
Okay, so from 90s down to like...
Nailed it.
60s.
Yeah.
Does that help?
What do we got under surveillance?
Under surveillance this morning, TK. If you don't interrupt, I'll get there. China, US tensions building to the G20 meetings. The US saying it's begun its official probe into the chip used in Huawei's Mate 60 Pro as the China tech company debuts an even more powerful phone, the Mate 60 Pro Plus. Tom, I'm not sure if this is to coincide with the G20 or to coincide with the unveiling of the new iPhone next week, but the timing of this stuff has been pretty phenomenal.
Are they a government company? I mean, I guess, are they a state-owned enterprise? I don't know. I mean, I get the angst. I mean, we had a balloon flying over America, but what's the linkage from this cell phone, Huawei, over to our fears about a balloon over Montana?
It does two things, actually, and it raises some questions for President Biden. Are his sanctions, are some of the restrictions on chip exports working? Are they doing anything? Is this going to foster a harder line in Washington? And what does this do heading into the election for him on that front? That's number one. And so it really presents an awkward scene for him. But then on the Apple front, what they want to do is say, hey, we can compete. And oh, yeah, hey, population, who is the audience of this? Is it the U.S. or is this a domestic audience to rally the troops and say, let's get behind this new China-made phone?
Apple in the pre-market just about positive by 0.1%. Let's talk about fragile energy markets. Gas prices rising as workers at Chevron's Australian LNG plants begin striking today. The impacted operations accounted for 7% of global LNG supply last year. And Tom, this is sparking a move in European gas prices every time we get a headline around this story.
We're learning about it. I've been doing LNG seminars for, 40 years? It was going to be the savior 30, 40 years ago, it seems like. And now LNG's dominant. And, you know, we're learning about the geopolitics of this and maybe even the one price of LNG. It's sort of like a Brent crude thing, but we don't follow.
I promised the end of the weather check, but I've got a little bit more weather for you. Hong Kong shutting down and cancelling trading today as the city is hit with its heaviest rainstorm on record. The pictures out of Hong Kong just absolutely
139 years.
Phenomenal. And here in New York City, we're hoping that we don't see scenes like this as Hurricane Lee strengthens to a Category 5 storm in the Caribbean. Lisa, the storm could hit New York and Boston as soon as next week.
We were looking at last night at some of these images at home, and I said these look like some of the Armageddon pictures of climate change and what happens to New York and other cities. You know what I'm saying? If you look at some of those movies, that's what it looks like when you see rivers going past, you know, the second floor of buildings in Hong Kong.
Under surveillance bonus. Let's get to it right now before we get to Stephen Major. Bonus round under surveillance. Steve Major demanded that we look. Do you know there's no Premier League football this weekend?
I'm aware of that.
What are we going to do? Let's consider North Macedonia, Italy.
Let's not.
Again, we're going to do it.
Who sanctioned this in the control room?
Alexander
We're not doing that at all.
This is Northern Macedonia scoring late a few years ago. Mr. Trichovsky.
Awesome.
Scoring here as well. How will Italy proceed today?
New coach.
Tomorrow.
New coach, Spalletti. He won the title with Napoli and Serie A.
They got to be fired up.
Last year. I hope.
Just like completely
I feel like cursing. I hope they're fired up because that was dreadful. That was dreadful.
It was a real low.
When have we done bonus round? That's not a bonus round.
Steve Major, it's the only reason we'll book Steve Major.
Bonus round, I just feel like I'm being trolled.
Steve Major, you're going to bring Major in here. He's living large. West Ham is having the season of all season because the guy went from Richmond over there to coach. And the answer is, you know, I got to watch North Macedonia, Italy, rooting for Italy tomorrow.
I'm not going to be watching that. I'm pleased to say that my good friend on my side, Steve Major, joins us right now, Global Head of Fixed Income Research at HSBC. Steve, wonderful to catch up with you, sir. We're going to park the football. We're going to talk about this bond market. You are bullish. What do you think the bears, Steve, have got wrong about the outlook for this bond market in America?
Well, where to start? I think that the list is getting longer and longer. When I look at valuations, absolute and relative valuations, treasuries just stand out. We completed our monthly asset allocation this week, and most of my colleagues have reined in their enthusiasm on other bond markets because they are not attractive. I mean, I'm struggling to find a single EM rates market that I'd want to buy right now. Much of the total returns come through FX anyway. Credit is tight. Treasuries are standing out versus equities. But at some stage, people are going to start moving from bills into bonds because they're going to start thinking about the opportunity cost. I'll tell you that I think that yields today, 10-year yields are 100 basis points higher than they were in the early summer, but they're the same level as they were in October 22. And since then, the Fed's hiked by 225 basis points. So something's going on to contain that 10-year yield. And I think it's difficult to see it going much higher. So I look at it and think it's asymmetric. Maybe nothing much happens. We go sideways for a bit. But when the yields move, they're going to move down and a lot.
Stephen, you at HSBC are hardwired into the China slowdown, the knowledge of China, the dynamic of their GDP. If we do get some form of new diminished Chinese economic growth, is that a disinflationary impulse that assists in driving yields lower, fixed income prices up?
Well, quite possibly, yes. It's not good for many markets. I mean, the EM tends to quite like a soft dollar and a strong China. It's got the opposite right now. So the channels through which China might matter to global fixed income are many. It could be through capital flows, it could be through trade and therefore GDP, it could be through FX, it could be through some form of contagion, some kind of financial stability incident. I mean, there's so many. The list is long, and it seems that already there's some influence. But what kind of policymaker is ever going to say what's really happening? We're going to find out afterwards. So I think that already you've got a big gap between the yield levels offered by China and many other markets compared to the US. And that's the thing I'm focusing on at the moment. It's very difficult to determine exactly what the channel and the process is going to be, but I think it matters.
How do you understand, Steve, why we haven't seen yields go lower this year? Why they've stayed so sticky and persistently so, with economic data surprising to the upside?
Look, we've just completed the most aggressive tightening phase in 4 decades. It looks like the momentum of the tightening is definitely fading, and I think that we're entering a very important period here where there's probably going to be a handoff from the focus on inflation onto the real economy data, and it's going to be a slow process. But I think that, I'll repeat what I just said. Yields probably go sideways for now, but when they make the next big move, it's very unlikely to be up. The next big move is more likely to be down, and therefore you're better to be long.
Are you saying that the risk right now is for some sort of systemic event and that you see one on the horizon versus the upside growth surprises that we have been seeing, which has led a lot of people to say that really the asymmetry goes to the other side, that growth could actually reignite? And I've heard that's even from Fed officials themselves. So
the GDP now is a notoriously volatile series. It's been goosed up by the fiscal loosening. And the trend GDP is still 175, 180. The smart people, I believe, recognize that the R-star is unchanged from before the pandemic. So the policy rate is more than double what the equilibrium rate is going to be. So it says to me that we are at or very close to the peak in the cycle.
So given that, Steve, how do you place a bet here out a year or two? Are you, on a retail basis, are you laddered? Do you barbell? What's the major strategy to go price up, yield down?
Yeah, that's now the key question. I've got much more comfortable with just outright long of 10-year plus, rather than trying to play anything fancy with the curve. If you start buying 2s versus 10s and play a steepener, you've got too much carry to overcome. And so the strategy favors taking duration over yield curve exposure right now.
I can't say enough, John, how important that is to see a bullet approach from a major bank. You don't see that nowadays. Everybody wants to do ballet, fancy CFA garbage. A major just says, shut up and buy it.
We're talking about treasuries here, Steve. Let's talk about that trade relative to what you expect to happen in the UK, in Europe. Is it a similar story, Steve, or is it different?
Well, the UK might be leading things today, at least. It happens occasionally, doesn't it? I think for every 100 days, maybe there's 5 to 10 days when the UK and the Eurozone can pull the US around. And today might have been one of those. The front end of the UK got some life into it. It seems like the UK could be at the peak. The data's supporting that. So it's all connected. I just think that at the moment, the relative value between treasuries and bunds and gilts and Aussie, Canada, it favors treasuries. Just run a spread series of the markets. And that's what's struck me, is that it's a relative argument, not just an absolute one.
Steve, final question. Top 4, West Ham. What does James Ward-Prowse have to do to get a call-up for the national team?
Hasn't he been great? What a joy. Surely he must be on the list, but it's been a joy to watch.
Just snubs by Southgate continuously.
I don't get it. TK. I read the press on this, Henry Winder and all that, and you guys are vicious over there. I mean, we don't have this discussion.
Oh, it's pretty brutal stuff,
it's brutal stuff,
the tabloids.
Nasty.
The sports pages. Steve, thank you, sir, for the update on the bond market and a sneak peek of some of the football chat as well over in England. Steve Major of HSBC. The asymmetric story around the 10-year bond and why he thinks yields are going to fall and this Treasury market is going to rally.
Yeah, I can't say enough about a guy like that at a major bank just saying, shut up and buy the point. Buy the actual indicated 10-year. If you want to get braver, go out farther. Point versus a lot of, spread talk and laddered and barbell.
Well, he said something in there that was really important. And he said that the smart people see R-star going back to what it used to be.
Yes.
And there is actually a huge disagreement on that. And I'm curious to hear, where the smart people shake out on that ultimately.
Steve Major's in a good place.
He's in a good place too. He sounded happy, didn't he?
He sounded happy.
Just got a note from Deutsche Bank on the ECB going into next week. They call it an uncertain pause. They say there's a real possibility of further hikes and later cuts. That's the ECB.
It's a pause.
Different chat
hawk
to the Federal Reserve. Pauses hawk.
No, you can even say it. I can't even say it.
What I'm grateful to say is that we've seen inflation come down. I feel like we're in restrictive space now, and now that we just need to let that restriction play out and let it bring inflation, continue to bring inflation down to get back into the range of our target. And if we can do that, that would be a good thing.
Sounds like patience from the Atlanta Fed President Raphael Bostic, just echoing what we heard from the New York Fed President John Williams speaking to Mike McKee. Looks like, TK, rate hikes are on ice. Going into the Federal Reserve meeting 2 weeks from now and going into the quiet period for the Federal Reserve starting this weekend.
Well, it's going to have to see, what's out there. We're in a good place, which is important. Bostic says that. Williams says that. That's going to be the mantra.
Goolsby said something similar.
The good place for us is, did you say quiet period starts tomorrow?
Yeah, no more Fed speak.
That's very good. Let's look at the Bostic GDP statistic now. It's a percent number, but we'll look at it to 3 digits, 5.576%.
We're calling it Bostic GDP
It's a Bostic GDP now.
Okay.
Statistic. He's, of course, running the shop at Atlanta. I don't know what to make of the number. I get it. People lecture me. It's the snapshot of GDP right now. Lisa, what do you think? 3/4 of the nation is like, really?
Well, even Atlanta GDP, the people who capture this data say that it doesn't account for certain factors that are going to probably bring it significantly down. That said, and I was actually just speaking with a number of people who are doing this on-the-ground research, if you look at the qualitative data, it is actually painting a similar picture as the quantitative data, which is that things are slowing but not breaking. And what do you do with that? As a policymaker, how do you nuance a message at a time where there isn't a clear angle to take? There's not a clear risk that's the preeminent one.
Have you been speaking to people that conduct the UMich survey? That's all you've been doing.
That
what have you been up to?
Every night. No, I was speaking to some people who are,
These your friends
close
again?
to the Fed.
Okay.
What you think that my friends are?
I'm just
You
trying to work out who the source is.
You want her home in her pajamas, and she's out
Some
partying
people.
with Fed officials.
Just trying to work out who Bramo's been hanging out with in New
Popping
York.
last call down in Soho.
Was this at the US Open? Fashion Week in Soho?
No, I
Fashion Week in
definitely was
Soho?
not in Fashion Week in Soho. Were you?
I was not at Fashion Week in Soho. Why are you asking? Why's the camera sitting on me? I wasn't there. I might have been there, but not for Fashion Week.
Not for
in
Fashion
Soho.
Week.
Yeah. Can we move on? Probably move on.
Let's move on now. We're going to move on.
That was a good
with,
comeback.
with,
Nice.
With, Brent crude, $90.43. That's something that has changed this week. We need a brief here on the Marshallian cross of supply and demand in oil. Amrita Sen is expert on this, Director of Research at Energy Aspects. Amrita, you've nailed this. How tenuous is the path from $90 Brent to $100 Brent?
I would say mostly stable from here. Famous last words. I don't mean like there won't be any volatility, but I do think the big move up has happened. We've been calling for $91 Brent in Q4, so we are pretty much there, a bit sooner than expected, but pretty much there. Look, could we touch $100? Of course we can. Are we expecting prices to average above $100 just yet? Without an outage, no. I think what we are probably going to see is, again, what you guys were discussing earlier, things are slowing in the economy, but oil demand is still very, very strong, don't get me wrong. And Saudi Arabia will keep supplies in check to ensure that inventories continue to draw. That's where we are right now.
Am I correct that the move 75-ish up to 90, demand is not diminished? I mean, the elasticity of demand here on the price movement doesn't seem to be evident. Demand just continues, right?
Absolutely. I mean, $90, I really don't think there is any change versus 75. I've always been saying that you don't really get a change till it's about $120, right? And then, but having said that, Tom, I will highlight that even though crude has moved from $75 to $90, what has moved in some ways the opposite direction are diesel and gasoline cracks. Even when Brent was at 80, you had gasoline and diesel cracks at 30 and 40. So what you and I were paying at the pump, sometimes even higher if you're based in Europe because of taxes, was say $120 to $130 per barrel. Now those product cracks are coming off a bit and crude has gone up. So it's a redistribution But the point still stands. Below 120, you don't really see an impact on demand.
Amrita, how much are we seeing growth drive this? The idea that the U.S. has outperformed, travel spending still seems to be robust. How much is that underpinning this more than just the output cuts that we've been talking about from Saudi Arabia?
Oh, I think demand is huge. Like, look, we started the year talking about or forecasting 1.3 million barrels per day of year-on-year growth. I've highlighted even to you guys that, look, we know we were on the low end, but I thought we'd come in more like 1.6, maybe 1.7. We're tracking 2 million barrels per day right now. First half of the year, we have full data for, and Tom's going to love this, demand has come in 500,000 barrels per day higher than we expected. And refineries have come in, runs have come in 500,000 barrels per day lower than we expected because they can't get hold of alternatives once they've lost Russian crude and feedstock in Europe and the US. So this has been a real struggle for refineries to meet the demand, but demand has absolutely outperformed. This has been a products-led rally in crude. When crude started rallying a couple of weeks or a couple of months ago now, it was products that led it. So it has had to be a demand-side story.
So in other words, are you saying that there's a floor for how much prices can go down, even if there is some sort of increase in production on the margins, and even if there is a bit of a slowdown just simply because of the roadblock that is refining?
Absolutely. The fact that refining is tight and margins are tight and product stocks are super low, that just means refining margins, while they will ease from current like crazy high levels, it started to ease already, will remain higher for longer, which provides a much more solid floor for oil prices. And I think also why, Prince Abdulaziz, generally Saudi Arabia, they are in a comfortable place. Very much he described to me as the situation is if you go in for a long bath on a Sunday, relaxed bubble bath, he called it. That's the kind of position he's in. He wants to make sure the market doesn't have too much volatility. It's stable, and he wants to keep that going.
Amrita, maybe off your remit a little bit, but Bloomberg has done wonderful work in the last number of days on the rebuild of coal usage in China. Has ESG taken a step back from the lens of Amrita Sen and energy aspects? Has ESG reverted or retreated over the last number of months?
I wouldn't say reverted, retreated, yes. I'm in Asia right now. I'm Singapore. I was in Beijing last week. I think ESG features, but features a lot less than it used to. Even in Europe, ever since the Russian invasion in Ukraine, when people have to pay up for energy, I think a lot of realism kicks in. And I think that's definitely what's happening. Look, ESG will remain here. It's not going to go away, and rightly so. We should absolutely endeavor, and all companies are pushing towards a greener future. But I think there is a bit more realism now that you can't just move away from fossil fuels overall, and the path needs to kind of incorporate both.
I mean, to me, the arch question here, and JP Morgan, I think, did some great work on this, folks. We will speak with Christian Malik in London here in about 8 days, is a basic idea that EM, third world, whatever you want to call it, they're insatiable and demand just is not going to budge. Is that the case?
I think that's been our view that, look, non-OECD demand will continue to rise because ultimately, and I think the Nigerian minister put it very well, saying we too are transitioning, but away from cow dung and wood to oil and gas. Remember, for a lot of these countries, electricity isn't even a given. And I think that's what they are focusing on right now. Everybody wants to grow. Everybody wants to get wealthier and fly and drive around. So we tend to look at energy transition from a very Western lens. It's very easy for Americans and Europeans to sit and talk about energy transition when the rest of the world is just starting to grow and have very similar aspirations of wealth and growth.
Too true. Amrita, thank you. Amrita Sen there of Energy Aspects. Thank you for the update. There's something amiss here, isn't there? How do you reconcile this story of a global growth slowdown with what you're seeing in the commodity market, both in crude and iron ore as well? If it was just crude, I'd say this is a supply story, but it's not just crude. It's iron ore at multi-month highs, Tom.
Totally agree. I looked at the Bloomberg Commodity Index. One of the first things I did in this fractured week here with the vacations in school and all that. And the fact is you're absolutely dead on, and I wonder what it means for China GDP. And this debate, Lisa, you've been great on this. Is it a domestic turmoil in China, versus a more econo-babble global China, which gets you to gloom of 2% GDP. I'm not there.
Leland Miller of China Beige Book was great on this. And he said, people are getting way over their skis in terms of how terrible things are in China. China isn't going to grow the way that it has in the past. But it's not exactly, collapsing. There still is a lot of demand. And that's really playing out. It plays to the iron domestic, but it plays to the iron ore a little bit more.
Crude this morning, Brent crude up by 0.5%, $90 a barrel. Just around those levels. WTI, $87. Do we know if ESPN and Walt Disney have sorted out that stuff with Spectrum?
They haven't, but we do know ESPN Plus, it's critical tomorrow, 3:45 p.m., North Macedonia, Italy.
Do you have ESPN Plus?
No, but I think I have to subscribe just to see Italy win.
I've got ESPN Plus.
It's been a pretty impressive cooling of the labor market throughout the course of this year.
We are expecting the inflation numbers to continue to come down.
Part of what's driving our inflation today is lack of labor supply.
I'm not sure that we've seen all the pain that this increase in interest rates will cause to the economy yet.
I believe that the soft landing scenario is the worst case scenario.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Soft patch going into the weekend, so weakness in this equity market. 3 days of losses on the S&P. Hello, day 4. Your equity market looks like this. Futures negative by 0.1%. Going into the Federal Reserve in a couple of weeks' time. That meeting just around the corner. The quiet period for Fed speakers. That begins in about a day's time, TK.
I just want to go back to it. I'm old school on this. I'm sorry. Everybody talks too much.
Is that including us?
Yeah, I was about to say.
Everybody. There's too many speeches. Can we just get a rule where they can only speak once a week?
Is that for us or
Shall
for
I restart the show? Live from New York City this morning. Good morning. Good morning.
What?
Does that help? Is that better? Just stop talking?
No, I'm not talking about you. I'm talking about the Fed presidents and all the communication.
Well, they stop now, don't they? From tomorrow.
Yeah, which is good. They should stop all the time. That's where I am.
All right, Bram, you're allowed to speak. It's okay.
Thank you. I appreciate that.
You've got Tom's permission this morning.
Okay, that's very exciting. I think it's a very hard message, and what we've been hearing from Fed officials has been pretty consistent, which is whether it's in a good place or not, there is some value to waiting. And that is a hard message for an impatient market to hear. Because nobody wants to wait. We want to price in what's going to happen. What's going to happen? What are you thinking about?
Yeah.
And there is no answer. They want to wait to get a collection of data that they can then say that they're dependent on, and they can massage in a certain way, because ultimately the data is confusing right now. It is incredibly confusing and really painting some
We're in a good
contradictory
place.
messages.
I mean, I'm sorry. John Williams came out. McKeene nailed it with that great conversation.
So if Williams says we're in a good place, we're in a good place.
I do a panel. There's no cocktails. They break out the
we?
cocktails for McKee and Williams.
You had drinks last night.
Yeah, they had drinks, and so they
Did
got.
John have drinks last night?
John said we're in a good
can
place.
confirm. We're in a good place. Let's talk about the labour market. Yeah. We're all anticipating the slowdown inflation. They use these words like rebalancing the labour market, a softer labour market, a weaker labour market. That's the objective of this Federal Reserve. So let's put two stories together. You've got this debate between a big union and the Detroit Three, GM, Ford, Stellantis. Still can't get used to saying Stellantis, but anyway, there we go. It doesn't make sense. But anyway, they're the Detroit Three right now. And you've got this debate ongoing, Lisa, where apparently 16% pay raise isn't enough for this union. So I'm trying to figure out whether these debates, these conversations, this tension between unions and the Detroit Three are the dying embers of a hot labour market, or maybe just another sign that this sticky inflation story, tight labour market, is going to stay with us. Which one is it?
Yes, you ask a different person, they're going to give you a different answer. There's both, and that's sort of the frustration right now, and giving some sort of blanket characterization. There clearly is a softening in the labor market. Did you see the story about Walmart quietly creating a new framework that lowered the pay effectively of starting workers?
Though,
it was
right?
super nuanced. They basically changed the framework to even out the starting salaries of different people. Either way, there are signs that they don't have to pay up in the same kind of way as they used to hire people. People are staying longer. They're not quitting as much. But in certain industries, there is a lock on the labor market, and that is what you're seeing, perhaps.
I'm glad you bring this up, because I think it's a bigger deal than we think. Are we going to have a auto strike at midnight, September 15th? And I just think it's, it's not that it's under the radar. That's Friday next, a week from now.
How does the president respond to it? On a campaign trail.
He's going to respond to it politically.
He said it a million times. He said it a million times. He's the most pro-union president in the history of this country. So surely the most pro-union president in the history of this country would support that strike. No?
He's going to take a middle ground because there's so much baggage with Detroit.
How can you reconcile taking a middle ground with that statement from this
It's
president?
not going to happen, John. That's what he said.
It's not going to happen?
Yeah.
He hopes it doesn't happen.
Exactly, because otherwise it does create a real issue.
Because then he should be out on the line with them, shouldn't he? As the most pro-union president in the history of this country. That's the auto manufacturers. Here on Wall Street, different story. Goldman, potentially, Tom, cutting the underperformers, according to the Financial Times. That could kickstart later next month.
But that's a calendar item. As Sonali Basak would say, that's what they do in September. That's what they do into October. They start lining up the underperformers. I'm going to call it 3% of staff. Maybe I'm wrong, plus or minus one, but the bottom line is it's the time of year where you do that. I really wonder how unusual that is.
It's a difficult time of year. Equity futures on the S&P, if you are just tuning in, welcome. Negative here by 0.1%. Yield's just about unchanged on a 10-year lease of 424. Crude still in and around 90, 87.30 on WTI. And the euro, we've used this phrase all morning, clinging to 107. 107.03, that currency pair positive by almost 0.1%.
Today, very much geopolitics front and center, which is a really hard thing to know how to price around, but has been dominant this week. President Biden heading to New Delhi ahead of the G20 meetings. He's got a bilateral meeting with Prime Minister Narendra Modi of India at 10:05 a.m., a real important meeting, especially in light of the tensions between the U.S. and China, and even China and India. Today, the last gasp of Fed speak includes Fed Vice Chair for Supervision Michael Barr at 9 a.m., San Francisco Fed President Mary Daly at 11 a.m., and the eco data is light, but we do get some sense of the household change in credit and the feeling that people have of wealth. We get household net worth at 12 noon, and consumer credit at 3 p.m. at a time where credit delinquencies are picking up just a little bit, but really nothing to write home about. Really subdued levels relative to pre-pandemic, John.
Bramo, thank you. Joining us now is Amy Will-Silverman, Head of Derivative Strategy over at RBC Capital Markets. Amy, let's start with volatility. That's your world. Why do you believe that volatility, and we have the ingredients for, a pickup in the VIX and Vol?
Good morning, John. So, I think the last time we spoke, I said I was reluctant to be the strategist who cried low vol. And the reason for that is we've just had option prices at decade-plus lows, and everyone knows that. And the issue is volatility can stay low for quite a long time. I think what's different now, and I think why we can catalyze higher volatility, is that there's just simply enough events happening. You guys mentioned the United Auto Workers strikes. There's going to be the debt ceiling. There's going to be CPI, just a slew of events coming up. But secondly, I think positioning has really changed. And you've seen that inflection in sentiment in the options market. And I think those two things can really catalyze low volatility from here.
Amy, something's changed here in your research note. You talk about the October skew that's out there, that there's a bet on the market. What is the size of the bet on the market right now? I can't get a handle. Are people legitimately gloomy and placing their bets gloomy or not?
Yeah, it's a great question, Tom. So I think the problem is the answer is a little bit nuanced. When we spoke a few months ago, front and center was the fact that there was so much mega cap tech exuberance. It was essentially overwhelming everything else. There was outsized call demand in NVIDIA and Apple in your Magnificent Seven. Essentially what has happened is a lot of that has waned. So you really, when you look at the call skew portion of the market in the Magnificent Seven and in NASDAQ overall, that bullish sentiment has really waned. And what that has done is it's really taken the tailwind out of the market. So that positive momentum begets momentum. Forced dealer buying, a lot of that has gone away, but we haven't actively seen that pickup in bearishness yet, although I do expect that could happen, especially with some of the recent news we've seen, but that hasn't actually happened yet.
So in other words, when it comes to the big tech giants, what we're seeing from Apple is also coming at a time where sentiment has been shifting, and further news that could catalyze the downside will be met with a sell-off in these tech names that's more significant than, say, a couple of weeks ago. Is that right?
Yeah, that's right. And, the other thing that I think is interesting, I was speaking with a client, and initially, when you look at the options market, Lisa, a lot of the fear has been concentrated in China and FXI, EEM, your related ETFs. And historically, that's actually been a flight to safety trade for mega cap tech. What I think is interesting this time around, you're not seeing that. So, perhaps this is very Apple specific news, but in the past few months, if things were not going well in China, a lot of that tech money from China would flood into the Magnificent Seven. You're not seeing that this time around, and you're seeing much more of the hit to long duration in general as we talk about the rate story.
What's the put bet right now on Apple? Just as one example. I mean, what's the weight of, what are adults doing on Apple here with an 8% stock pullback?
So when you look at the differential, Tom, between that call skew and the put skew, you see substantial waning in the call skew. So meaning a lot of that bullish sentiment, that air has been let out of the market, and you're starting to see that pick up in that put demand. So that isn't somewhere where I would say, hey, look, this is at historical all-time highs. We're not seeing that yet, but it's steadily climbing each day as this continues to be in the news of what China's doing with the ban and things like that.
Well, not to be rude on Friday, but I got to make some money. Does Amy Wu Silverman load the boat this morning on Apple because the skew's gone negative?
So one thing we've been talking about closely as well with Lori Cavaccina, our head of equity strategy, is are we going to see that rotation now from growth into value? Is this the time where that really catalyzes? If that is the case, what I would say is a lot of your volatility across the board has still remained quite attractive. So you can play that in either two ways. You can use that to catalyze long volatility hedges in your mega cap tech, or you can use it to be long something like volatility in IWM through calls.
Amy, thanks for the update. Amy, Wu Silverman there of RBC. You want an update on one of the biggest bears on Wall Street? No longer the biggest bear on Wall Street. Greg Bowdle of BNP Paribas, 3,400. He brings that price target higher, Tom, to 41.50 on the S&P. The bear capitulates over at BNP.
The bear capitulates, but he resets a little south of where we are right now. So, and these are all nuance, and it's good to see that they reassess, they readjust, and that's what you do when you're wrong. I've been wrong, and more often than I care to admit.
And we'll be wrong many times in the future as well. Here's the quote.
Thank you.
I said we, not you.
Oh,
our outlook for this year was always predicated on the idea of seeing a recession in the United States. Greg goes on to say, I think us, along with many people on the street, have been surprised at the resilience of the data in the United States. Not just resilience, Lisa, but so much better than anticipated, just looking at the surprise index. I have to say, more recently, though, that surprise index is starting to roll over in the other direction.
It is starting to roll over, although not meaningfully in sort of this sudden spike downward. This surprising resilience has raised a lot of questions among a lot of people, which is how much is behind it and how restrictive are rates and how much further could things go. And people just don't know. And I think that this is really the surprise. How is it that the U.S. was able to withstand 5.25 percentage point increase in benchmark rates without catalyzing some sort of significant downturn, even with all the debt and leverage that everybody was talking about?
That is the great missed call. And the answer is, and this came up a little bit yesterday in my seminar, the answer is, we made the move. And as we've talked about for 12 months, the x-axis goes out and there's this longer thing. And if you're longer, you're in a good place.
Because no one's paying it yet. The difference between where the Fed is and where the effective rate is.
Exactly.
If you're in your home right now,
Ben
you're still
Laidler
locked in at
2-3%
mortgages. If you're a corporation, you issued debt in the pandemic, you locked in those low rates for a longer amount of time. You've got to wait. And it's the waiting of it where we start to see it buy potentially further down the road. We haven't had the great refinancing at 5% interest rates just
Ben
yet.
Laidler at eToro was brilliant on us. We're 18 months into it right now.
If you are just tuning in, welcome to the program. Equities right now on the S&P 500, negative here by 0.1%. Tom, looking forward from here, a big debate over in Detroit. The Detroit 3 facing down UAW, going in potentially into a strike a week away.
Fancy elites on Wall Street can walk away from it. Olivia Waxman for Time Magazine does a brilliant send-up. I don't remember this, John, but it was in the fabric of the 60s where you began to get aware of economics and that. 1958 was brutal. There was a guy named Walter Reuther who ran the UAW. He was magnetic. He just had that je ne sais quoi thing. And Walter Reuther and the UAW in 1958, and Olivia just points out with the Kohler strike then, hugely long strike on the plumbing front, backed by the UAW. And the idea of, Lisa, if you've mentioned the union waiting then versus now is just stunning, where now we're down to 10%-ish union. And back then, it was the fabric of America, 35%.
Just getting this line on the G20, Tom, cited by a person familiar with the final draft. From what we could get from the G20, a challenge to long-term growth from cascading crises New book from Al Arian, Gordon Brown, Michael Spence, Permacrisis, a plan to fix a fractured world. What a timely release of that publication.
Absolutely.
Later on in this program, Dan Suzuki of Richard Bernstein in the next hour.
China has made decisions over the past years that have made it more difficult, not just for Canada, but for other countries, to engage in ways, I will admit, in 2015, the conversations we had was about working on towards a free trade deal with China, working towards those sorts of things. But in real terms, the choices and the actions of China have made that more difficult.
That was Prime Minister of Canada Justin Trudeau speaking to Bloomberg's Eric Shasker in the last 24 hours on China, going into the G20 commencing a little bit later on this weekend. The president touching down in New Delhi, India, in about 2 hours or so from now. Some reporting from here at the team at Bloomberg, according to a person familiar with the matter, familiar with the final draft of the communique, or at least the draft of that final communique. Leaders of Group of 20 nations plan to warn that cascading crises pose challenges to long-term economic growth while calling for a coordinated macroeconomic response to it. I mean, how much coordination can we expect at the G20 level?
It took a committee of 14 people to come up with that statement beforehand. I sat with Simon Kennedy once at the St. Regis Hotel where Jon Snow stunned the world with some kind of G20 thing. I remember the room was electric. Are we going to get that in India? I don't think so.
What I find interesting is you have this sort of vanilla G20 correspondence at the same time that we're getting headlines from CCTV over in China that Xi is planning to boost state firms' competitiveness and plans to speed up building infrastructures like energy pipes. This is tangible, on-the-ground types of measures at the same time that G20 can't really come to those agreements to make those strong actions. So I think you're really raising a good point here about the ambiguousness of
Nailed that.
That was beautiful. It's Friday,
Sound like Tom Keene.
Don't worry about it.
Thanks, I appreciate it. All right,
I'm not even going to make an attempt.
Why is the camera still on?
I don't know, it did it to me earlier. It was like Fashion Week Soho. Boom.
Ambiguousness.
Wouldn't let it
there
go.
We go.
Wouldn't let it go.
Right.
Breathe. It's all right.
Saving the program right now in Washington, our chief union correspondent, Amory Horton, joins us as well. Amory, one of our themes is to get out front and look to next week. I believe the President of the United States will return from India, and it returns to something that's the fabric of his ute, and that is a union on strike. I am fascinated, Amory, of your reporting on the union tone inside the Beltway. It's got to be so different from 1958 or from what Biden knew as a senator.
Well, Biden is trying to revive that. This is something he ran on. And as we say a lot, he uses this term a tremendous amount of time. I actually can't keep up. But he says he wants to be the most pro-labor union president in modern history. Part of this issue is that he also has a multitude of goals he wants to achieve over his presidency. He also wants to be the most pro-climate. We've seen at times these ambitions really come head to head, and he has to almost choose where he wants to lean into. Is it the environmentalists and electrifying the grid, or is it the labor unions? But what we're seeing right now is we could potentially see a strike as soon as next week. This contract is ending September 14th, and the language coming from the UAE continues to be fiery. I pulled up Sean Fain's statement. Let me just bring you some of this.
Please.
He says, after refusing to bargain in good faith for the past 6 weeks, only after having federal labor board charges filed against them, GM, which came back with a counter yesterday, has come to the table with an insulting proposal. He also goes on to say that GM either doesn't care or isn't listening when we say we need economic justice.
Right.
The clock is ticking. Stop wasting our members' time. Tick-tock. That is the level of acrimony within these negotiations happening right now. And kind of like when the president went to the G7 in Japan, he had to cut his trip short. He has a number of domestic issues hanging over him when he touches down in India.
Is the nation pro-union? I mean, I got a president who's pro-union and the romance of, what he knew in Scranton and Delaware and all that. But is America pro-union?
I think it really depends on where you live and who you ask. Because while this is also happening, it's been a hot labor summer. You've seen a number of unions and workers really want to demand more from their employers. We still have writers and actors on strike in California. We have a tense negotiation between American airline flight attendants right now after the pilots were able to strike a pretty good deal for themselves. I think it was one of the biggest we've seen in history for the pilots. But if you go to the South, where it's right-to-work laws, you're not going to see very pro-labor individuals. It's right-to-work culture. So very much depends on where you are and also who you ask. Because to John's point, this entire week, the number of people that are actually part of unions has really dropped dramatically than what we saw, say, in the 1970s.
It's easy to say you're pro-union, the most pro-union president in the history of this country when union membership is this low. Because most of the time you can have your cake and eat it. The real test will be if there's a strike. And Anne-Marie, given what the president has told the general public of this country, time and time again, that he believes he is the most pro-union president in the history of this country, shouldn't he be striking with them in a week's time if that strike begins?
I do not think you're going to see the president go to Detroit and take the picket line with these individuals, but he will use the bully pulpit. And what we do know is that he's already has Gene Sperling trying to work in between these individuals, between the big three, between the UAW, to make sure that the government is keeping an eye on these negotiations. I mean, a statement came out last month from the White House about these negotiations, about the potential strike. So when the president says he doesn't think there's going to be a strike, clearly they are worried because they already dispatched someone over the summer, and they've even put out a statement already. So clearly they are worried if there's going to be a strike. What does this mean for the impact of the economy? What does it mean for the fact that we already have a low amount of cars that are being built in terms of the manufacturing base, the fact that they've been catching up due to the COVID pandemic and their inability to get some supplies. And also, what does this mean for his EV agenda?
Who is the point person for this, Anne-Marie? Just to jump in, we don't have a confirmed Labour secretary. We have an acting Labour secretary. We have a president who, from the outside looking in, looks like he has a cosy relationship with Mary Barra of GM. Who's the point person? Who's dealing with the auto manufacturers within the White House?
Well, I'm sure the Labor Department is involved in this, even though you're right, with Marty Walsh leaving and they've not been able to make sure they can have that Senate confirmation of the acting individual, Julie Su. Gene Sperling has been the person that's been involved with both the big three and the UAW.
Right now, Anne-Marie,
that's the name to watch.
Just real quickly here, just want to finish up with the last question where you mentioned that you're in Washington, D.C., you're not in New Delhi, and part of the reason why is because there's negotiation to prevent this government from shutting down in the near future, and that's one of the exogenous risks out there, a really important thing to be focused on. What are the chances? Does it look more likely that they're going to get some agreement?
It looks more likely depending on, well, this is another one depending on who you talk to, but if you see what the lobbyists are talking about, we had a Congresswoman Maliotakis from New York on yesterday. No one is saying, no, we're not going to shut down. They are saying there is this potential, and that's what it's looking like. And really what I would watch for is the divide between the Republicans, between the House and the Senate. While you see Senator McConnell come out and say, we want to get this supplemental through, attached to a continuing resolution, that aid for Ukraine, the aid for disaster, put it on top of the bill that's going to keep the government functioning after September 30th, what you see from House Republicans is Speaker McCarthy is potentially looking at ciphering off the Ukraine aid and putting it into a different bill with what Democrats would view as controversial policies for the border and asylum seekers. So there's going to be a huge fight, not just within Democrats and Republicans in the House, but between Republicans between the House and the Senate. And that's why this is going to be really a labyrinth for Speaker McCarthy to navigate.
AMH, thank you. Anne-Marie on the latest down in Washington. Appreciate it. Our chief Washington correspondent on the latest of the negotiations between the big three in Detroit and UAW, Tom. Crunch time now into next week and double-digit pay increases on the table, not getting it done.
Yeah, and also the arch call, are we going to get a union group, a labor group, back to a compensation structure that they knew from another time and place? To me, that's the arch idea. They changed it in the bankruptcy crisis and all that. And are they going to change it? Are they going to revert back to it? I guess is the way to put it.
And I think that, you're right to ask John about what the political implication is for President Biden. Where is his allegiance right now? He wants to be pro-business. He wants to also be pro-worker. He's trying to figure out who he can cozy up to at a time.
Come on, his polling ratings are 39%. It's working great.
But it's not because of the labor unions, I would argue. Yeah. I would argue there are some other issues there.
Maybe he's trying to be everything to all people, just like you say.
Yeah, I've got no comeback to that, Tom. Earl Davis of BMO, asset management of fixed income, coming up shortly. Your equity market just slightly negative on the S&P. We're down 0.2%. Live from New York City this morning, equities pulling back 3 straight days of losses on the S&P. Hello, day 4. We're down by 0.2%. Over those 3 days, down not even 1.5%. Not too dramatic. On the Nasdaq, down about 1/3 of 1%. A lot of people looking to Apple over the last couple of days. Over 2 days, Apple, a 2-day loss of a little more than 6%. Going into the big unveiling next week of the iPhone 15 this morning, Apple is down by just 0.1%. In the bond market, 2-year, 10-year, 30-year. Looks like this. Yields unchanged. 10-year, 424.82. 2-year, 494.64. Yields going absolutely nowhere. Snoozy bond market going into the weekend. In foreign exchange, nothing snoozy about it for the last 8 weeks. 8 consecutive weeks of dollar strength. It continues in the last 24 hours. A breakdown from 107 to 106. Been clinging to that 107 handle all morning, and there it is again. 106.98, Tom, on the euro against the dollar.
I'm glad you bring this up. You're right. It's sort of it's a strange Friday, but this to me is a surprise. There's been absolutely no give back on euro. I'm under a 107 to me. It's the 4 decimal points, but it's there. And the other way I'd go is renminbi goes the same way with all the management by the government to almost 7.34. So between the yuan and the euro, those are sort of the items of the day.
It's been quite a week. Some pushback from Japan, some verbal intervention. China trying to push back with a stronger fix over the previous few days. You wonder if we see more signs of them maybe giving up that effort. And then into Europe, the euro weaker when there's an inflation problem, clearly, at a time where the growth story's getting worse, going into the ECB next week. I can't overemphasize this, Tom. The ECB is in such a tough spot with President Christine Lagarde.
And even more in the last 48 hours.
Big time.
I mean, the German data, wow. What does the Bundesbank say? Let's raise rates and bury manufacturing even more.
Manufacturing's already buried. That's the problem, isn't it? Under surveillance this morning, we've talked about it for the last 30 minutes or so. United Auto Workers rejecting a counteroffer from General Motors ahead of Thursday's deadline. GM offering a 16% pay raise, $11,000 in inflation protection for top wage earners, plus a 56% hike for newer employees. The entire offer comes short of the 46% raise in the union's initial bid. Just yesterday, Ford announced it's boosting wages for 8,000 hourly workers. Tom, none of this is getting it done right now into next Thursday.
I just wonder what happens. So they strike. And so they strike for 5 days, 10 days. No big deal. They got a fund. I mentioned 1958 before. But I just wonder what the duration pain is there. Sort of like the actors' strike, because a lot of them have second jobs. There isn't that duration pain.
Did they miss the boat? And this is something that's a bigger question about whether the mood has shifted in the labor market and whether the anecdotes that we keep hearing about keep showing that actually there's quite a bit of softening right now in the labor market and that people are not getting hired as quickly and they are quitting less frequently. Going to the office.
I'd folded in also the Lions upset the Chiefs last night. I think that
Detroit got a win.
They got a win. Oh, that's a big win.
It's a rare win, right?
Or do they actually have a good team? Suggest rare is a bit too harsh from you on a Friday morning, but
Well, I thought they were terrible.
Detroit's exuberant.
How did a UAW discussion turn into the Detroit Lions?
Come on, it's Detroit. It's a Ford family.
They actually won a football game.
So maybe they'll get this.
I heard Michael Barr talking about that on radio this morning when I was getting ready to come on air. And I was like, oh, Detroit actually won. I'm surprised by that.
Barr's a stud. I mean, from Chicago to Buffalo, he's like known by everyone.
And Michael's going to email me in a minute. He'd be the first to admit that it's rare. More job cuts coming to Goldman Sachs, according to the Financial Times. The firm expecting to let underperformers go as soon as October in a 1 to 5% cut in headcount. Back in January, the bank set out to reduce as many as 3,200 positions in one of its largest rounds of cuts ever. I know exactly what you're about to say, Tom. It's back to normal on Wall Street. Is that right?
Yes, because Sonali Basic's going to say calendar item. What's Morgan
It's
Stanley?
not a calendar item for the people on the wrong side of it, is it?
I didn't say it was, but this is a time of year where you line up. You got Bonai in February, and you got to pay your top 10% of your people more money than God. This is what you do.
It also is Goldman Sachs in the headline, and everyone's click, 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 click. Do we understand what's going on with David Solomon? I mean, at a certain point, that's part of the issue. He was going on and talking about how the stories make him into a caricature, and he doesn't even recognize the person when he looks at it.
He had a conversation with David over at the Death Star.
I saw that interview yesterday.
What do you think? I missed it.
I did a good job with him.
Yeah.
I'm not sure the other guy did a good job
Faber's
responding.
brutal. I mean, he's just ruthless.
Given enough opportunities to act like a human being.
Yeah.
And struggling
he
to
did
act
okay?
like a human being at times. That
pretty much summed it up.
Wrapping up the Fed speak ahead of the September meeting, Dallas Fed President Logan saying, quote, skipping does not imply stopping. Atlanta Fed President saying the following,
well said.
We're in a restrictive space. And in New York, the Fed President John Williams telling Mike McKee that policy is what, Tom? In a good place. But emphasizing the need for more data on where we go next.
For radio, we got the 3 quotes lined up. It's a brilliant graphic, John, and that it really shows the nuances that are out there. And, I'm not going to pick one over the other because they've each got their own character and their own positioning within the hawkish, dovish parlor game.
We know the phrase high for longer. Goolsbee thinks we're just about at that time where it's time to think about the longer piece of this and move away from the higher part of it. Goolsbee mentioning that again from the Chicago Fed in the last 24 hours as well. You get the feeling from all of them, hawks or doves, that's the conversation already taking place. If we are sufficiently restrictive, if we're not running a hike or two away from being so, once we get there, Tom, how long do we need to stay here?
Well, the longer is the heart of the matter, and we're going to go to that right now. It's great to have Steve Major with us with HSBC and to have Earl Davis with us today with a heritage with BMO Asset Management in Canada, Bank of Montreal. It's just great to have Earl with us. Earl, I love the pedigree. It's your fault the Toronto Maple Leafs are terrible. You were at Ontario Teachers for years. They used to own the Maple Leafs. They're the ones that buried them into obscurity. You've been on the investment side of debt and also, of course, working with BMO Asset Management right now. And your code here is longer. We are going to be longer. How longer is longer for Earl Davis?
Yeah, I think we'll be higher for longer for, most likely until 2025. I don't foresee any cuts next year for 2 reasons. One is all central bankers are telling you that, and I think we have to believe them. The other thing is you see the economic numbers, right? The resilience. Even though I know you guys were discussing jobs and the decline there, but there's still excess demand for workers. It's still positive. So the question is not whether things are declining, it's whether they're declining fast enough. And I believe some of the secondary data that we're getting is telling us no. And that means if they're not going to hike too much more because they have to wait to see the cumulative effects of hikes, they have to hold on for longer.
Accumulate us across 2024 to year 2025. How does fixed income react to a longer that most people aren't predicting like you are?
Well, the interesting thing is we don't believe there's hikes next year. We believe there are hold next year. So what happens in that environment is that the longer end of the curve starts doing the fight against inflation, and that comes through the market doing the fight against inflation. So there's 2 things that have to happen first. One is the market right now is discounting eases in the 2-year bond all throughout next year. I think there's 4 or 5 eases discounted in the US. That has to work itself out, and that means higher yields across the board. But we believe we'll have steepening before because people are scared of the UAW negotiations. What's the impact of that? Because let's say there is, for argument's sake, a 25% increase in wages. That does not show itself immediately in inflation, but it will show itself in 6 months as car prices go up because your costs are going up. And this is happening across a number of industries. So we believe we are in that wage price spiral. We've seen a number of wage gains this year, your pilots, we saw UPS, significant wage gains, which doesn't show up in inflation until people start paying and buying stuff with that increased income. So we believe we're in that spiral. That's why it'll be higher for longer. And we don't foresee cuts until 2025. At earliest, late Q4 2024, but I don't anticipate that at this point.
We talk a lot about the long and variable lags, and there's a huge disagreement about whether they've already basically impacted on the economy or if they are yet to come. Aside from just the Treasury market, when you take a look at credit, Are you seeing companies being able to absorb some of the higher rates and all of the debt sales that we've seen over the past couple of days? Or is there something else going on that makes you think it's going to bite in a more material way?
Well, they could easily absorb the debt hikes from where they're refinancing. And the reason why is, let's look at U.S. 10-year bonds. Let's say a company issues U.S. corporate credit say 100 above overnight, above 10-year yields. They're still earning a positive return. They're not paying because of the inversion of the yield curve and where overnight rates are. So it's not costing them as much as people think, especially the ones who issued last year or the year before and still have 5, 6, 7, 8 years left on this debt. I think this is part of the story and part of the reason why we're seeing the resilience in the market that we're seeing, especially from corporates. There's no earnings recession. There's no margin compression at this point in time. And that's something that has to change for inflation to come down as well.
If you do have some sort of wage price spiral, are you saying, Earl, that we're on the cusp of a reacceleration of the U.S. economy that people are not foreseeing, and that slow sort of soft landing and decline is not an accurate portrayal?
It's a great question. The answer is it depends. And it depends on what the Fed and FOMC reaction to that is. It's our belief it's going to be very difficult for them to hike in 2024 because of the election. And I know they're independent, but it does impact popular opinion when politicians are talking about hiking, when things are turning. So it depends on the reaction function of the Fed. If the Fed chooses to counter that reacceleration, if it does happen, then no, we'll be all right. But if they choose to wait because of the cumulative effects and because of other reasons, then we could see some ongoing volatility in the bond market, especially that 10 to 30-year sector.
Oh, that word but. Can I pick up on that? They're independent, but I've always struggled with that, Earl. They're either independent or they're not. There's no buts about it. Why is there always that but?
I'll give you the but. Let me answer that question for you. They are independent, but the politicians, Congress, Senate, they could change the mandate of the Fed in 5 years. So they're independent now, but the reaction function in 5 years in regards to the ongoing mandate, that's subject to change. That's not permanent.
Interesting. Oh, you think that might change then?
I didn't say that.
I'm just asking.
That is in the cards.
Okay.
So that has to be taken into account. Let me look at it, rephrase it. I'm a fixed income trader. I look at net present value. So which means your cash flows over the next 10 years. When the FOMC makes a decision, they have to look at what's the impact, not just immediately, but next year, 2 years, 3 years, 4 years, 5 years. Part of that calculus is what I'm saying. And that's what you have to distill back to ensure that you have longevity in what you do. And that's how we kind of see the game theory of monetary policy, fiscal policy. And that's how we put our risk on. We look at this and we incorporate that into our risk taking.
That's fascinating. Oh, thank you. Thank you for the explanation. Earl Davis there of BMO Asset Management on an independent Federal Reserve.
It's a conversation of the week there in fixed income. There's just no question about it. That is an outlier call, to say the least.
If you are just tuning in, welcome to the programme. Your equity market shaping up as follows on the S&P 500, negative here by 0.26%. This from Andrew Honhorst and the team over at Citi.
Missed that.
Base case. The FOMC will skip hiking at their meeting this month, then deliver one final 25 basis point hike in November. It all depends on core inflation picking up somewhat in August and September and the labour market remaining tight. If that happens, Tom, if that's the case, they believe there's one more to come, and that one more comes in November.
So they're data dependent. Andrew Hollenhorst is data dependent.
Essentially, that is what Andrew is telling you.
John Williams at a good place is data dependent.
Well, here's what I'm thinking about a lot, which is we're clearly shifting to a place where they're going to be on hold, right? Where they're not going to be raising rates further. Whether they raise rates one more time or not, or whether they raise it 2 more times even, does that really make that much of a difference? What are the criteria to shift away and to start cutting? We still don't have any sense. We have the John Williams view of things, and then we have the view of things of we're never going to cut because we don't know what's going on. So this, to me, is really how do you game out beyond that, which is basically what markets are trying to do.
It's counterproductive for them to talk about it. We've talked about that a few times. Counterproductive because there is still an effort to get inflation down, and once you start engaging in that conversation with any depth, detail, Tom, once you start doing that, you could get a premature easing of financial conditions, and I'm not sure they want to go there right now.
It's just a bunch of what if. What is it, the 13th of September?
Tom, markets is a bunch of what if, isn't it?
Okay.
Isn't it the whole business
Who's the hottest team in baseball?
That's the only tangible thing we can discuss.
Who's the hottest team in baseball?
I don't know. Who?
The dreaded New York Yankees are the hottest team in baseball. They're playing
they
5-0. They're 8-2 the last 10 games.
Didn't they just lose?
I know they lost. They're 8-2.
Okay.
They're on a tear.
Torsten Slok, Apollo, in the next hour from New York. This is Bloomberg.
Right now, I think, things are moving in the right direction. We've got policy in a good place, but we're going to need to continue to be data dependent, watch the developments and assess what we need to do. We'll have to keep watching the data, carefully analyzing all of that, and really asking ourselves the question, is this sufficiently restrictive? Do we need to maybe raise rates again?
One of the best, if not the best, Mike McKee, sitting down with the New York Fed President, John Williams, here at Bloomberg at our headquarters in New York City. We're in a good place, TK, according to President Williams.
Well, he said all the right things there, but to me the heart of the matter is his comment on data dependency. And next week is a big week for Bloomberg surveillance. We start right off on Monday and dash to the PPI, the CPI.
CPI on the 13th, yeah.
Northern Macedonia.
ECB on the 14th, they'll ignore
results.
you. Next week, the Federal Reserve after that.
Yeah.
You want to talk about the football this weekend? Let's avoid that altogether. Can we bring up Apple stock? Let's take a look at that stock over the last couple of days. 2-day losing streak. Those 2 days down more than 6%. Down more than 6% over the last 2 trading sessions, Tom, off the back of this story of China banning some iPhones at the government level, potentially state firms as well, based off our reporting. That stock got hammered yesterday by about 3%. Going into this iPhone launch next week with Huawei potentially providing a little bit of conversation, a little bit of competition. This is a change, TK, from where we were a few weeks ago.
We welcome all of you worldwide, particularly in the evening across the Pacific Rim. On Apple, Bloomberg is definitive. We have a gentleman named Mark Gurman in print who writes with great authority on this worldwide. He has published overnight. I've gotten that out on Twitter, and I'll do it again. Look for that from Mark Gurman. And as well as Mr. Gurman, we have Mr. Webb. Alex Webb is a student of all this technology with a global reach out of Queen Victoria Street in London. Alex, does Huawei have an ecosystem?
No, is the short answer, although don't forget that their operating system tends to be built on Android, which is the Google ecosystem. The challenge, I think, for Huawei, which has got this new device that, from a headline perspective, appears to be challenging the iPhone, are they able to make enough to challenge the iPhone? But don't forget, when we think about China and we think about ecosystems, it isn't the same as in our part of the world. They use WeChat and that whole sort of super app platform, which means it's easier potentially to pull yourself out of an iPhone and go into an Android or vice versa. Whereas the platform I use is this one. It's the iPhone. It's iOS. That is my super app.
What will Apple do? We've had a lot of speculation here about how they'll respond. You know the people. How will the management of Apple respond to the last 48 hours?
They take a long-term view. This has happened previously where they've had, for example, they issued a profit warning, I think 4 years ago, and all of a sudden everybody started writing off Apple. They've now, $3 trillion valuation. So they will probably say, don't worry about this. This is a small-term blip. They've had a blip in the past as well when there was a sort of resurgence of nationalism when it came to purchasing in China. People being encouraged to buy Chinese-made devices. You could say the iPhone is a Chinese-made device, but owned by Chinese companies. And Apple had a bit of a hit for a quarter or two. They tend to take a long-term view on this stuff. And I'm sure that's the messaging in Cupertino.
Alex, one conversation we've had around the desk today and over the last couple of days, actually, for Apple and Tim Cook. Tim Cook's been a phenomenal diplomat, navigating that tension between the US and China and seemingly not upsetting either side, even when the former President Donald Trump was in the White House. Alex, if Apple is in the crosshairs of this now, I'm thinking about everybody else. Alex, who are you focused on beyond Apple in China at the moment?
Wait, in what sense? You mean in terms of other Western companies with exposure?
Absolutely.
Well, the whole Apple supply chain, basically, right? These are the people who occupy vast tracts of the tech industry, the likes of Qualcomm, who, they've also taken a bit of a hit as a consequence of this. I think, to your point with Tim Cook and the way that he straddles that divide, Tim Cook, in a sense, is a very useful figure to have, almost at times arguing your corner from the Chinese perspective. You know, he needs access to China both from a manufacturing and a market perspective, because they make all the devices and they are the second biggest market. So Apple needs China. China benefits also from having that sort of symbiotic relationship with Apple, because he is able to argue the case in some instances on Capitol Hill, say maybe don't carry out quite the extent of sanctions that you would otherwise want to do.
To exactly that point, Alex, at this point, doesn't Tim Cook have almost more of a free leash to basically go to India, travel over to New Delhi and say, hey, let's start ramping up production here?
Yes and no, right? Like, it's taken 15, 20 years for Apple to build out this supply chain in China. It's not something that happens overnight. At the same time, India is nowhere near as mature a market as China right now. China does something like $75–80 billion in revenue for Apple. They did, the most recent numbers we have from our own reporting in March is that they did $6 billion annualized revenue in India. So it's a huge delta there for them to catch up. It's not as though you switch from one to the next, from 1 year to the next. It's going to take a hell of a lot of time.
When you talk about how China does depend on Apple, is this sort of flying in the face of that, or is this basically just casting similar things that the Chinese government has already done in new ways, right? I mean, this is something, for example, the encouragement of state-owned phone companies or manufacturers, that was always encouraged in some of the state workers, right? Some of these things are being trumped up at a time to really push back in the public eye against the U.S. What's your view?
We are starting to see a real tit for tat happening in terms of the US introduces one set of sanctions, the Chinese responds by blocking access to the market for one company. This seems like a relatively easy thing for them to do. It's kind of at low stakes, despite the market reaction. You're probably looking at 1% of their total sales or unit sales in the region affected by this. The bigger question is the mood music, right? Does it affect demand from the broader Chinese market? It's unclear that that's going to be the case,
Alex,
but that seems to be sparking some of the concern.
We didn't have you on for all this mumbo-jumbo about the mood music. When they do their product launch next week, is it a big deal that they changed the pluggy thingy into USB thing on the new iPhone? Is that earth-shaking?
No, I mean, it's also not something they're doing of their own volition, right? It's something they're being forced to do by the European Union. But you assume, therefore, people have these plugs already. Like, that is something around the fringes that makes very, very little difference, despite how they might present it next week.
When you watch that stupid show, to me, it's the most contrived thing ever.
Which show?
The Apple show,
Which one?
The launch. You know, they're going to do the
Wanderlust next week.
What's it called?
It's called Wanderlust, isn't it? Something like that.
Really?
Yeah, that's what the event's called
Alex,
next
do
week.
you care oh my God, they're wearing a turtleneck? Or, give us the backstory on the show, Alex Webb.
I mean, look, I have very little tolerance for those things. I've been to plenty of them. The thing that's, you hear all these people applauding in the room when they were in-person events, which they're not anymore. The thing you've got to remember, most of the people in the room are Apple employees who made this thing, right? Those are the people who were applauding.
There we go.
The people who were sitting there quietly typing away at the laptops are the like of me and Mark Gurman, who are, doing our jobs as journalists.
Is there going to be any surprises?
What surprises are you looking for?
I don't know. Well, the surprise is 2 iPhones in the house have broken in the last week. That's
unsurprising.
A shocking surprise.
Perhaps.
Alex, we have to leave it there. Alex has to actually do this.
We have to follow the clock too, Tom. Apparently he's got to go. Alex Webb.
Oh, sorry.
Thank you, sir. Out of Bloomberg in London.
I mean, you and I get to laugh about it. He and Gurman have to actually go to the show.
Too. They have to deal with this garbage, yeah.
My favorite is that this image of all these workers clapping and then the reporters in the sidelines being like...
I'm pleased we're done with the lines around the corner from the store and people have just figured out you can get this thing delivered to your house.
Yeah.
Like, just order it through the telecoms company, whichever one you might use, and it will arrive. It's pretty simple, TK.
Yeah, I just... I just think it's a lot. I mean, I get the Chinese angst thing. China's in huge turmoil right now.
One thing
somehow to get fixed. It always gets fixed.
One thing that Apple's done really well is just branding and style. I mean, that's sort of where it won, right? That Steve Jobs won on style and aesthetics.
Luxury.
Sort of, right, and
Galloway talks
a
about
luxury
this. He's been
good,
great on it,
and then it's also, a staple. And so the idea of wanderlust, does that create an ad to this style and the hype.
It's going to have a lighter
Around
weight.
Fashion Week in New York.
You wanted to bring that. You want to go back to Fashion Week.
A lighter weight titanium frame.
The problem is, Tom, they've made this one so well. I don't need to upgrade this thing anytime soon. I'm not a professional photographer. I don't need the brand new camera.
The last toy,
so long as the battery lasts.
The battery.
Enough.
The last toy, the battery is game changing.
And also just the charging connector. Had to have that replaced recently.
Yeah.
Whatever. Michael Barr writes it. Michael Barr writes it. How rare is that win? Against the defending Super Bowl champs, and convincing. It wasn't a lucked win. He says, Lions strong.
There we go.
That's your Detroit report this morning. Dan Suzuki of Richard Bernstein up next.
The market is waiting to see a definitive turnaround.
We think about potential GDP in the U.S. at somewhere between 1.5% and 2%.
There is so many moving parts. There's so much data which is really contradicting each other.
It seems like the desire is to pause and wait a little bit.
It would be so historically unique to see a soft landing here without a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. We're in a good place on a Friday. Resetting for September, the quiet period for the Fed. Resetting for October, November, December. The difference of opinions today, John, on the show, extraordinary. Steve Major, HSBC, lower yields. Earl Davis, BMO Asset Management Canada. You got to be kidding. We're going to be longer for longer.
Seema Shah said it. Contradictions in the data and in the markets right now. So let's talk about a few of them this week. The data, jobless claims, the lowest since February. Claims are moving lower. Never mind that break in the labour market.
Morning in America.
At the same time, the ISM pretty strong earlier this week, Tom. That conflicts with what we heard from the beige book. The slowdown story, China, Europe, that conflicts with what we see in the commodity market. Crude at highs for the year. Iron ore at multi-month highs. When you have those kind of contradictions, Tom, it's confusing. So for the Federal Reserve, they're going to wait. They're going to be patient. They're going to skip September based on the communication we've had from them so far. Yeah. Whether that changes with some big CPI print next week, it's not anticipated or expected, but things can always change.
I'm on my way to the November meeting already. I mean, I just think that's where we
Holland
are.
Horse this too.
In the bet on is Torsten Slok to be with us, I believe, in this hour. We're going to have an equity conversation coming up, which is really the conversation of the day with Mr. Suzuki working with Richard Bernstein. And it does fold into the stock market bet. Apple, OMG.
2 days of losses, Tom, of more than 6%. It's going into the unveiling of the iPhone 15 next week. There's two stories you have to look at. Competition from Huawei, potentially, with their new phone. And secondly, based on reports from the Wall Street Journal and from us here at Bloomberg in the last couple of days, that this iPhone ban is spreading. It's getting wider from state agencies in China across to state firms maybe as well, Tom.
Lisa, yesterday, Anastasia Amoroso, I'm sorry, let me paraphrase, load the tech boat.
Well, she was saying that in terms of the AI bet longer term. But then we were hearing from Amy Wu Silverman of RBC Capital that there was something that preceded the Apple noise, which is a shift in tone among some of the traders, people getting less long, less bullish, a little bit more caution really coming into some of the trades that we've seen so far. This is a really uncomfortable moment because it feels like we're on the precipice of some change, but people don't know which way it's going to break in, and you see that reflected in some of the uncertainty in the market.
Well, then make the call, Lisa. Which way is it going to break?
Really? Okay, thank you.
Yeah, I'm going to ask John the same question.
Well, clearly to bearish side. No,
it's Friday. We're into the season.
Kind of.
No, actually, to be completely honest, there might be a bigger risk that there is a reacceleration, that things keep going better than expected.
Yeah.
And we saw this from Michael Hartnett today of Bank of America. The biggest risk to stocks is not a recession, is not an actual catastrophic event that causes rates to come down. It's that yields remain higher for longer, that things keep chugging along. That creates a very different valuation perspective for some of what's out there.
We stopped the show worldwide for a report. We're pleased to have with us our chief football correspondent. This from Bloomberg. Saudi clubs spend 8.75, 87% of $1 trillion zillion on football players in, quote, summer frenzy. I mean, Saudi's trying to buy up sports, right?
So that transfer window just closed in Saudi Arabia, which is why we now have the official tally of $875.4 million. And it could have been more. They were after Mo Salah of Liverpool. There were numbers being thrown around of 200, maybe 200 plus. So that number could have been a lot more. It's not going to stop there.
Wait. Did the Red Sox give him $200 million so he wouldn't go and stay with Liverpool?
I'm not sure what Fenway Sports, who also own the Red Sox and Liverpool too, so I can explain that for people who don't know. I'm not sure, Tom, what they offered.
Julie Swinehart wrote out a check for $200 million?
This isn't over. Now, some of the European clubs are very unhappy with the disruption coming from the Saudi teams offering up a load of money. There's another side to this story. European football has had absolute dominance over talent for decades now.
Right.
A monopoly on the best players from Latin America, from Africa. They're all playing in Europe. And now we have a different destination available to some of these players. Not necessarily just the ones at the end of their careers. It's going to be interesting to see what the younger players at the top of their game do.
How can they say no? I mean, you can get, am I right? You can get, I mean, the guy from Man City, the tall blonde guy in the front, his father's career was ruined, right?
By injury.
By injury. I mean, these kids live this, don't they?
As far as I understand, Kylian Mbappe said no. So there are players at a younger age, in their early 20s, who are saying no to that money.
Are they saying no and getting, did Salah have the Red Sox do this so the Red Sox fall into last place?
The likes of Kylian Mbappe are getting huge sums of money. His contract's set to end, I believe, next summer, and we'll see if he goes to Real Madrid, and we can talk about the numbers then. I'd actually like to compare these numbers out of Saudi to the numbers in the Premier League, and I don't have that in front of me right now.
Oh, the Tots didn't spend $875 million on whatever debris they have after Mr. Keene over at the Bundesliga. That's your football report for the day. We welcome you. We'll try to save the show with a data check right now. John, I'm going to steal your thunder. 107.03 on Euro. Can't get out of its way.
Thunder, stolen. 106 just moments ago, Tom, in the last hour or something. 107.03. We're positive on that currency pair by 0.1%. Dollar strength is story for the past 2 months. 8 consecutive weeks of dollar strength. In the bond market, yields higher by a single basis point, 425.42. Equities just a touch lower here. We're down by 0.1%, Tom, on the S&P.
Here in the first week of the season, we need to recalibrate on the equity markets. You can do that with the shop of Richard Bernstein. The deputy CIO at Richard Bernstein Advisors is Daniel Suzuki and joins us this morning. Daniel, Richard Bernstein's work is definitive. Style investing was classic near 30 years ago and so appropriate right now. Is Bernstein navigate the noise, investing in the new age of media and hype? It's like you could redo the book this morning. Help us navigate the noise right now. How do you go long stocks amid all of this 2023 noise?
Yeah, Tom, that book was written, well before the age of Twitter and social media. So you can just imagine, the exponential growth in the amount of noise out there that you have to ignore. Ultimately, I think it behooves investors to come back to brass tacks fundamentals. And that's really, what are the profits doing that you're buying and how much you're paying for those profits? And I think people have lost sight of that, and people just invest in stories without a care for those underlying fundamentals. Now, the profit story for a lot of these companies out there, no matter what sector you're talking about, is still pretty good. And we think it's going to accelerate from here. So I think that is very positive. On the negative side, though, people have no care for how much they're paying for some of these stocks. And that's where I think, the rubber meets the road. I think people are paying too much for certain areas of growth. They're not paying enough for other areas of growth. And Tom, you alluded to style investing. One of the core tenets of that is as growth starts to accelerate, we think profits growth will start to accelerate over the next couple of quarters. Investors will become comparison shoppers and realize that there's no need to pay 30 or 40 times for companies that can grow at double-digit earnings growth, where there's other companies that trade at a fraction of the cost that could grow at multiples of the growth rate. And I think that's the classic rotation that we could see going forward.
Okay, so are the Magnificent Seven among those that are too expensive, or are they the ones that have the best growth picture going forward?
Yeah, I think from both sides, Lisa, I think on one hand, I think they are the crowded, expensive part in the market. If you take those 7 or the sectors encompassing them, if you take them out of the market, you're looking at very, very reasonable or very, very cheap valuations everywhere else in the world, in every other sector of the world, right? So that is the one area where things are expensive. Now, does the growth justify those valuations? I think that because, as I was saying before, people have gotten so excited about the growth prospects, the growth expectations are very, very high. And I think those growth expectations are going to get dwarfed by the traditional cheap cyclical areas of the market that are more sensitive, to the pickup in profits growth that we could see. So I think there's potentially risks on both sides, Lisa.
If there is a pickup in profits, as you see, and particularly in some of these areas that haven't gotten as loved as the Magnificent Seven, what does that mean in terms of the new neutral rate and what that kind of does to forward-looking returns? I mean, if you have benchmark rates that stay around 4%, doesn't that materially change your valuation lower in some of these equity markets?
Absolutely. I think what you're saying is that if growth is going to accelerate and inflation is just demand outstripping supply, demand's going to pick up. And inflation pressures are going to pick up, and that's going to result in a tighter Fed and higher rates, and we're going to have to, price that in. And I think in that world, there's certainly an argument that the more expensive stocks should trade cheaper. But as I said before, there's really one expensive part of the market that's ultimately at the biggest risk of that higher rate scenario. The rest of the market, whether you look at the equity risk premium or just the pure valuations, are actually still quite reasonable.
Dan Suzuki, how do you and Richard Bernstein avoid a Disney? What a disappointment. What a strategic seismic change in an industry. For our viewers and listeners, how do you avoid a certified blue chip stock that falters?
Well, I think you got to stay away from just investing based on the story. The story got everybody excited about the growth prospects, the new businesses, the technology applications, the franchises that can't, that you can just rinse and repeat. And I think that the story got a little too exciting and people got too overhyped about that story. Again, that's going back to navigating the noise. Ultimately, comes back to, what are the profits doing and what's the macro environment and how conducive is it to that story. And I think that's where, you ran into a little bit of expectations getting a little too elevated.
Dan, thank you, sir, for the update. Dan Suzuki there, Richard Bernstein Advisors. RB looking for opportunities in the rest of the world, Tom. Seemingly the international story for them, not as dire as it is for others.
Style investing, nearly 30 years old. It is one of the great, I'm going to take 5 great books on equity investment, John. It's a little bit of a heavy lift. There's some real meat in there from Richard Bernstein, but I can't say enough about the intelligence of that effort. It was seismic when it came out near 30 years ago.
If you are just tuning in, welcome to the program. Your S&P 500 negative over the past 3 days, trying to avoid a 4th day of losses. We're negative here on the S&P 500 futures down by 0.1%. Coming up in about 18 minutes' time, 8:30 Eastern time here in New York, we'll catch up with Torsten Slok of Apollo on the path forward. Always has great charts every single day. Torsten just churning it out over at Apollo. And in just a moment, don't miss this, Pierre Ferragu of New Street Research on Apple after a tough 2 days going into the unveiling of the iPhone 15, Tom, next week.
Really important voice. He is not a fanboy. Just as simple as that. This is a guy doing securities analysis wrapped around not a skepticism and not a meanness about Apple, but just always considering that premium valuation that's been placed on it.
Apple at the moment in the crosshairs of tension between the US and China, and maybe in the mix as well, this Huawei launch. On Huawei, we heard it from Alex Webb in the last hour.
How do you pronounce it?
Is it Huawei? Huawei?
I'm asking you.
Okay, we'll try that with Pierre Ferragu in a moment.
Yeah.
On that particular company, which has launched a new phone and an update, debuted a more powerful Pro Plus, whatever that is, a little bit earlier on today, Tom. On that particular phone, something you heard from Citi, you heard from Alex Webb too, do they have the capacity to produce it?
Yes.
In mass to compete with Apple and the iPhone 15?
I don't know. I don't know the price point or that. All I know is like Samsung, OMG, Apple's going to die. Samsung's got a new toy, Android, blah, blah, blah.
We've done this a million times, granted, I understand.
We said it.
Totally.
I'm like, okay.
I know. Are we going to move on? No, we're going to ask the same question in about 5 minutes.
I'm on my Edulary Haverty right now.
What's that mean?
Larry Harvey used to laugh at the people that would say Apple's going to die. They're just, the product's over. This won't work. These AirPods will never work.
I was one of those. I didn't want to wear the AirPods to begin with.
They don't fit
I waited for everyone else to use them, and now I use them all the time. Mainly to stop people from talking about you. Just walk in with them.
I wear the Beats.
Walk around the office with them. You wear Beats.
I wear the Beats, the
that
red
suits
ones.
You. That suits you. Nice.
The smart people, I believe, recognize that the R-star is unchanged from before the pandemic. So the policy rate is more than double what the equilibrium rate is going to be. So it says to me that we are at or very close to the peak in the cycle.
The bond market bull is still bullish. Steve Major of HSBC. Welcome to the programme. Counting you down to the opening bell, about an hour and 15 minutes away. Going into it, futures negative just slightly through most of this morning. We're down by 0.1%. Apple just a little bit lower as well. 2 days, losses of more than 6%. We're down here by 0.2%. We're looking ahead to next week, Tom, just around the corner, the iPhone 15.
We're going to get right to it right now. This is an important conversation. Pierre Ferragu has been just brilliant and decidedly not an Apple fanboy. He is Global Technology Infrastructure Head at New Street Research. Pierre, I love your phrase, the Silicon Wall. I'm going to give you credit for that, the Ferragu Silicon Wall. That's attention this morning. Is there a Silicon Wall identifiable between America and China?
Well, I don't think we see the wall yet, because China is buying about 20-25% of any Western tech company or any Western semiconductor company. So there is still China is still a very big market. But what we see is that both sides are working very, very actively at building up that wall, with the US, increasing restrictions, China doing their best to develop their own supply chain. And you see, like with Huawei this week announcing their first, high-end phone powered by a homegrown chip. These moves are very important and are setting the foundations for the wall in some ways, and that's the way I would think about it. And it took like a few centuries to build the wall of China, and it's probably going to take a decade or two to build the Silicon Wall as well. It's going to take a very long time for China to be able to be more autonomous and for their ability to replace Western suppliers.
Your note, Pierre, your note is extremely constructive on short term for Apple in China. What is the power, the sway that Tim Cook has over the Chinese government and over the Chinese manufacturing establishment?
So let's. I think you raise a good point that China has to be very careful to what they do with Apple, because China depends on Apple for many things. They are even more important in the upstream of Apple than the downstream of Apple. That's a very good point. But even if you take a step back, let's talk about Elon instead of talking about Tim, and see what happened in 2021. China banned the use of Tesla cars for a similar scope of Chinese officials, Chinese military, state-owned companies. And how is Tesla doing in China these days? Pretty well. So, these bans, the direct impact of these bans is very, very, and to be honest, actually invisible. You don't even see it. And so that's the reason why I'm a bit constructive on the situation. You're like, this ban is not going to affect Apple in the near term. Of course, it's a wake-up call for investors. They're like, oh my God, this situation with China is not getting well. And I think the ban is one thing, the Huawei phone is another one. And it's not a coincidence that we see the two things popping up in the same week. So the way I see it, whether it's Tim Cook or Elon Musk, these guys have a good ability to engage with Chinese authorities, understand the importance of China as a market. China understands the importance of having them building factories, leveraging the Chinese supply chain. And so, nobody is going to mess the Apple cart in the near term. But in the longer run, I think you have to keep in mind the Silicon Wall is building up, and slowly but surely China is going to get out of the mix of the revenues of an Apple, of a Tesla, of an Intel, all Western technology.
So at what point are you looking to see how much Tim Cook heads over to New Delhi, to Mumbai, to really have a discussion about expanding production in India?
Yes, exactly, very similar, very slow moves that are going to play out over years and years. So it took China like a few years, to be able to put out a chip that could power a phone that could more or less, compete with an iPhone. But still lag well behind, and revenge is a dish that is better that tastes better cold. And now China is starting to putting up this phone and in a position to start pushing back on the iPhone. And Tim Cook and his team are very clearly, cognizant of that, and they're making sure they're lowering their dependency on China as well. So that's a wall building, slowly but surely.
I have to say, this is a frustrating conversation to be having, not because anything that you're saying is frustrating or not incredibly interesting. It's more just going forward that it feels like we have all these geopolitical headlines, and then we have people coming on and predicting with really no basis of whether this is something meaningful or something this isn't. How do you just deal with this? You just discount all of the geopolitical headlines as near-term noise and look at the fundamentals and say longer-term maybe, but we have to really wait and see.
Yes, Lisa, I wish I had started a hedge fund 24 months ago, just buying the dip of every geopolitical headlines, and I'm pretty sure I would have made a lot of money. China, the Silicon Wall, the tensions between China and the West. The way I like to frame it is the following. Let's say China is on average 20% of Western tech. And let's say in a decade or two from now, in 15 years from now, China is out of the picture. That means Western tech is going to lose barely a point of growth every year over the next 15 years. So yes, you can reflect that in your DCF valuation and things like that, and it's going to give you a single digit, headwind on your valuation if you're a fundamental investor. But at the end of the day, it's not a big deal. It's not. We are ready for that, and because the market is what it is, every time there is a piece of news, it's massively overreacting on something that is going to play out over 15 years. So yes, I tend to see each of these reaction as a buying opportunity.
Pierre, I'm happy to look at opening that fund with you. Look forward to working together. Pierre Ferragut of New Street Research. Pierre, thank you, buddy. Always great to get your perspective. Going into that unveiling of the iPhone 15 next week. Going into the next hour on Bloomberg TV, Mohammed Al-Arian of Queen's College, Cambridge, and of Bloomberg Opinion, Binky Chadha of Deutsche Bank, Sarah Hunt of Alpine Saxon Woods, Dan Ives of Wedbush coming up as well. Mohammed in the FT this morning talking about China, Tom, and why it won't necessarily become the world's largest economy because of the challenges domestically. So a lot of things we've got to talk about here. China, the economic challenges. China, the iPhone. We'll do that with Dan Ives and this equity market with Binky and Sarah TK around the opening bell.
That's a great mix of people there. And granted, you've got two bulls there with money in the market and Chad and Sarah Hunt. But the summary to me is the tone of those four guests is about American exceptionalism, which is a foundation of what John Williams said yesterday. There's all this uncertainty and the toxic brew that's out there and da-da-da-da-da. You know what? We're doing okay.
He gets to say we're in a good place. And we get to say we're in a good place relative to right now, not just China, but also Europe, Tom. Chairman Powell is in a much better place compared to President Lagarde. Chairman Powell, without a doubt, on September 20th, does not have the stress that Lagarde has to confront a week from yesterday, TK, when the ECB convenes at the Governing Council. They've got a much, much tougher decision to make through the next several months, given what's happening with that economy and to Germany specifically.
And with Thorsten Slock, who was with me on a panel last night, I guess he's joining us here in minutes. And the answer is, there's this turmoil where America it seems that every conversation comes out better. How do you bet against that?
Not our opinion. Push it through the FX market, Lisa. 8 weeks of dollar dominance, 8 weeks of dollar strength speaks to exactly what we're talking about.
I was reading this one estimate, I think it was from Deutsche Bank, that taking the $190 billion decline in Apple valuation would have put it in one of the top 11 stocks of the
amount they lost.
Of the stocks, just to give you a sense of how that relative valuation would be over in Europe, which doesn't have the tech story. And oh, by the way, didn't have the fiscal stimulus story either. And I think that's going to be a big discussion.
It has Novo Nordisk now.
Yeah.
Hey?
I mean, come on.
And that's benefiting from what? US exceptionalism of a different kind.
All right. You trolling us?
Kind. Not at all. I live here.
Sugar lobby?
Part of it, something like that. From New York City. If you didn't get the joke, that's probably a good thing. This is Bloomberg.
Bloomberg Surveillance on a Friday, getting you into the weekend to a hugely eventful week next week. Lisa Abramowicz and Tom Keene, Jonathan Ferro in deep preparation for the next hour.
He's in a quiet period.
He's changing into bright yellow to interview Dan Ives here on Apple.
I love his outfits.
Yeah, well,
sneakers,
it's
so great.
Fine. Could you see me in that look? I don't think so. Dan Ives in the next hour on Apple with his enthusiasm yesterday. There's some gloom pushing against Ives. I mean, there's some tangible...
Yeah, the market.
The market is down 8%, 9% on Apple, and it's like, okay, now what?
Well, yeah, Pierre Ferragudo just said that he wanted to go back a year, 18 months, and create a hedge fund to buy every dip in Apple shares on geopolitical headlines, and he would have made a killing. And there are a lot of people who kind of are doing that playbook right now.
There's no economic data at 8:30 right here this morning.
No, there's none.
But his agent called and said, put McKee on so we can talk about Williams yesterday. So here's Michael McKee doing a victory lap here on what we saw with John Williams. There was a surprise in there. You always crowbar it out of every Fed official. What was the Williams surprise yesterday?
I think that people may have been surprised by the fact that he's not doctrinally wedded to R-star. It's a useful item. But it is not something that guides his policymaking because, as he admits, you don't really know what it is in real time. His monetary policy stance is pretty much as it has been for a couple of weeks, and as most of the Fed officials are feeling right now, that they could skip. The data will tell them, and I think they're just waiting for the CPI more or less to give them a rubber stamp to skip than anything else.
Do you feel like Fed officials right now are kind of happy? They don't want to seem happy. They don't want to seem satisfied. But do they just kind of feel pretty happy?
There is no fun allowed.
Yeah, no. Well, I mean, just in terms of that things are in a good place.
Yeah, I mean, Williams summed
landing.
It up. If you were trying to design an environment that you would achieve from your policy, this is it, where you've got still relatively strong growth and you've got inflation coming down. Will both continue? They don't know, so they can't take too much of a victory lap at this point. But this is not what people expected a year ago. I mean, recession was the base case.
We've been talking about the UAW potential strike and some of the discussions with the Detroit Three and what this could mean in terms of both where the supply and demand is in the labor market, but also just how sticky inflation could be. How are Fed officials thinking about this? Are they paying attention?
Well, they're definitely paying attention because it would have an impact on the economy. We're talking about 150,000 workers at unionized auto plants, and then you've got a spillover effect to the suppliers who have to decide whether they're going to keep producing and build up inventories that aren't getting used, and they may not be getting paid for right away. So there is a knock-on effect, but you can't know if they're definitely going to do it. That's the problem. And then you go into it knowing that the strike will happen and then it will be over.
Right.
And then it works its way out of the economy. And so do you make policy based on that? Probably not.
Michael McKee, thank you so much. An important conversation yesterday with the head of the New York Fed. I got futures flat here right now. The VIX 14.45. Euro's what John and I are watching. Euro dollar 107.06. Off of the Williams confab yesterday was a really important seminar. And my final question to Christina Campany of Invesco, Lee Farage of State Street, and one Torsten Slok of Apollo Global Management was on Williams R-Star. Torsten, I was absolutely thunderstruck by the responses. Campany out at 4%, Lee Farage in a 3 handle, and even you going all unanchored on Williams and suggesting we go from this 2% nirvana up to something higher, under 3%, but something higher. How does our world change if we get a new interest rate regime out there somewhere?
Well, I do think a very important implication is that then the cost of capital will be higher. The cost of capital will be higher for companies. The cost of borrowing for consumers will be higher. And all that will, of course, imply that we're going to have more of a significant impact, at least in the near term, on not only consumption, but also on corporate spending.
Through price, do we see asset price reduction because they got yield up, price down in a simplistic way?
Yeah, because your equity risk premium model, if you change the risk-free rate, and you permanently increase that for whatever reason, demographics, energy transition, less immigration, whatever it might be, if you have the discount rate going up in any finance model, on page 1 in your textbook would tell you that then risky assets are going to become less attractive relatively.
This has been a fascinating week because we've seen the fastest pace of issuance this year when it comes to investment-grade bonds, the third busiest post-Labor Day couple of sessions going back to 2010. Companies are saying, okay, rates are going to be higher for longer. We're going to sell debt because you know what? We're going to have to just absorb these higher costs. Isn't this a positive sign that they're actually able to absorb these costs and able to access the credit markets and things keep going even if at a more expensive rate?
Well, I mean, broadly speaking, of course, September is mainly having a lot of issuance because the summer normally has relatively low levels of issuance. So first, there's a seasonal issue why issuance has been so high this week. But the other issue is also that, well, we're at the same time in the background seeing that the high yield default rate is actually moving up quite quickly in the last 6 months. We're now, at least on the Moody's default rate, we are at around 4%. And if we keep rates at these levels, you know, every day on the Bloomberg terminal, you see stories about their companies that cannot get a new loan, companies that cannot roll over an existing loan, in particular for lower rated companies with higher leverage, and especially when it comes to interest coverage ratios. Interest coverage ratios, which measure earnings divided by interest expense, is coming down both for IG quite quickly and also for high yield. So it is not the case that all firms just have locked in long duration of lending. It is the case that we are actually seeing interest coverage ratios going down both for the IG and high yield index.
This is fascinating, the spike up that we're seeing in high yield defaults, albeit from really low rates and albeit still at historically low levels. When you pass that out, or you basically model the next 6 months, the next 12 months, do you end up with an acceleration of these defaults, or does it kind of plateau? Are we seeing the pain now as some of the rate hikes come into the market?
Well, this is really important because so far, the soft landing argument is that it has been very orderly, the slowdown in the labor market. It's been very orderly, the slowdown in inflation. So what's the problem? Well, the problem is that in the background, if you have this increase in default rates, especially in high yield, and remember the high yield industry basically has employment of roughly 11 million people in the economy, so it's not small. So the conclusion is if high yield default rates are going to continue to move higher because companies cannot get financing, well, then the effect will be that maybe at the moment these are names that many people tell me, oh, we haven't heard about. Well, just wait until you get a default in a name that actually everyone has heard about. Then that industry, that rating, that type of interest coverage ratio, that type of leverage is going to be much more vulnerable. And that could change sentiment potentially quite quickly, in particular in high yield, but also in IG.
And just across the board in terms of what kind of rate structure is going to be important going forward, as we were hearing from Stephen Major of HSBC in particular, that catalyst event. From your vantage point, how does this play out? The bear case, is it some sort of deep recession? Is it some sort of fissure in the credit markets? Or is this just a recession, the one that everyone was calling for earlier this year?
So I do think that it will be a continuation of what we're seeing. The Fed, the ECB, they are stepping harder and harder on the brakes. And this is not just about the change in interest rates. This is about the level of interest rates. And as that process continues, if you on your Bloomberg screen type ECFC go, have a look at what non-farm payrolls are telling you about Q1 of next year. The consensus is expecting that non-farm payrolls in January and February and March will be 12,000. So you now lean back and say, well, if we're getting non-farm payrolls in 6 months, that will be close to zero for 3 months in a row. How do you think risk will trade on that? And if that process of slowing the economy down as a result of the Fed having raised the cost of capital continues, we should expect to see an ongoing slowdown ahead of us. And I do think that ultimately that will create a risk of a harder landing.
In the last 18 months, coming out of COVID, with all the original economic framework that we have, the supply shock, et cetera, we've had so many things wrong. We got the recession wrong. We got before that transitory wrong. We got 4 other things wrong. The Red Sox, we thought they'd, have a good year. It didn't work out. And Harry Kane would never leave Tottenham. What right now that's a consensus call do you think we're going to sit back a year from now, 18 months, and go, God, we got that wrong?
What I think is truly fascinating is that we did go into this year, all of us, expecting a sharper slowdown than what we saw.
Yeah.
And because of excess savings in the household sector, this just took a longer time. More people have been traveling on airplanes, staying at hotels, eating at restaurants. The service sector, which makes up 80% of GDP, has just been a lot stronger. So it is a bit ironic that this process of slowing things down has continued. The Fed has kept on raising rates. Cost of capital continues to go up. Delinquency rates for credit cards and auto loans continue to move higher. And just as all these things finally started appearing, everyone said, well, now we're not going to have more of a slowdown. Now it's just Goldilocks and we'll have a soft landing.
So you think Goldilocks right now is the thing that we're getting wrong?
I do think that the risk is that this process, remember, think about what the Fed is doing. The Fed is raising interest rates because they want us to spend less money on our credit cards. They want us to buy fewer cars. They want us to buy fewer homes. That's the whole idea with slowing things down.
Off of Jonathan Spence's classic work, in Orville Schell published, I believe it was in the Telegraph, I stand corrected if that's wrong, Orville Schell writing on China. What I'm getting out there right now basically is a death of China. All my radars up, Torsten, and you wrote on it this morning.
That is a major risk, and the Fed had a working paper a few years ago where they tried to quantify what is the impact on the U.S. of correction in Chinese GDP, and they found a relatively modest impact that a 1% decline in GDP only had a 0.2%. In China, had only 0.2% impact on the U.S. But this is now to be tested because China is not only slowing for cyclical reasons, meaning exports are going down because U.S. is slowing and Europe is slowing. They also have two other issues, namely the housing situation is getting more serious. And on top of that, they also have the demographic situation that's getting more serious. So all that combined is generally going to drag down GDP growth in China and also have implications in particular for Europe, but also for the US.
But just one of the big counterpoints to the bearish argument that you're making is that growth has surprised to the upside, and it continues to, albeit at a slowing pace, and that companies are still doing well. How do you understand that surprising resilience?
Yeah, well, the nuance to that is that growth in employment has continued to slow down. And also when it comes to are companies really doing well, but why are default rates then going up so much? Why are interest coverage ratio going down so much? All these things that credit conditions are tightening in the background, interest rates are essentially, as the Fed wanted, biting harder and harder on consumers and biting harder and harder on corporates. And combining that with student loan repayments coming back and also households running out of excess savings, at least according to the San Francisco Fed, you can begin to worry about the next few months having a continuation of what the Fed wants to see.
That's a Slockian gloom.
Well,
but seeing the slowdown continue going ahead.
What would you have to see to change your view?
So what we need to see is essentially the cost of capital coming down, because the first domino brick in this process of the data that we're all watching across the board is that the Fed has raised the cost of capital. And as Tom was saying, maybe there are some reasons why the cost of capital might now be permanently higher. And the fact is that all this higher cost of capital is having an impact across the board, in particular consumers, corporates, but of course also again on high yield default rates moving higher.
Torsten Slok with us, so we're going to continue here right now. We've got two data points here. Let me tell you about the Standard & Poor's 500, a bit of green in the screen, up 0.1%.
Torsten Slok is presenting the bear case here, and I do have to wonder, Tom, how much pushback he gets from people who are sick of being wrong with the recession calls of earlier. I see a lot of potential pushback. I'm curious what that is.
Can I translate that? She sees a toxic brew out there. you see a toxic brew out there?
And people push back against it.
No, I think as an investor, let's summarize what this means for investors. It basically means that if we weigh the risks up on the scale, then the risks are still that the list of bullet points to the downside continues to be fairly lengthy. So that's why, yes, true, it could be that excess savings can last a little bit longer. It is also true that we could get still a little while longer, that things are okay. But the bottom line is the Fed wants to slow things down. Don't fight the Fed.
Right.
And with that, we should continue to see things slowing down.
Let's rip up the script here. Looney just exploded. Schatzker did it. Schatzker's conversation with Trudeau. We got strong Canadian dollar. No, pushing against it. And once more, Lisa, this really dovetails in with your observations here. Canadian dollar extends gain after jobs report beat in Canada.
And wages
Trudeau
accelerated.
On his way to India is going, yeah.
Is he, though? And this is sort of the question.
Open a Labatt's.
Maybe. And wages accelerating. But again, does this play into, well, something else is going on here? Again, it's just the confusion. It's a swirling, toxic confusion.
Toxic brew. Torsten, but this goes to the surprises out there and the resiliency that we see. We were going to run out of time here, Torsten, but we got to get you back on this. I think that there's any number of ways to slice this. folks, is extraordinary. What can I say on a Friday? Good news from north of the border. Futures up 1. They explode higher. The VIX 14.38. Canada, there it is. Loonie 1.3609. Stronger Canada.
China's not going to go away. China's always going to be here on this planet. The U.S. isn't going away. We're always going to be here. It's kind of like an arranged marriage. It's not a marriage based on love. We don't love each other. But it's an arranged marriage where we have to learn to accommodate each other. And I'm hopeful that that's at least can begin to be one of the results here.
Relationship counseling with Max Baucus, former U.S. ambassador to China, talking about how both nations exist. They got to work together to some degree. Not working together, though, right now, Tom, giving some of the tit for tat that we keep hearing on both sides.
81 years old, Max Baucus will forever be 50. He is so vital. He has so much energy. He's been a public servant of the nation out of Montana, and then he did a tour of duty in China, and this guy's authoritative. It's like Mike Marshall from years ago in Japan. I mean, Max Baucus has an understanding of China like nobody to beat the band.
So does Anna Ashton, who's coming up with Eurasia Group. But I do want to just give you a sense of why we're so focused on China. Apple shares very much front and focus after 2 days of losses of more than 6%. They've turned up, which is interesting. The buy the dip. Maybe the Anastasia Amoroso view of things taking over, up 0.3%. Also up, and this is interesting, Ford and GM shares both up almost 2%, even with that looming potential default on September 15th by the UAW and the offer from General Motors of a 16% pay rise, of the offer, just actually not even the offer, the Ford. What?
I mean, you said a default. It's a strike. We don't call it a strike. We're going to go on default. We're going to go on default. I like that.
All right.
Elegant.
Well,
it's more elegant.
Thank you. Well, defaulting on showing up, it's basically...
We're on the picket line defaulting.
Okay, moving on. Thanks for calling me out on that, Tom. I know I can count on you, but there is going to be a question here about whether longer term there is going to be some ramifications, or this is just the market gaming out that they're going to get to some resolution ahead of that time.
I am in the camp with Goolsbee of Chicago. Does he speak today? That Goolsbee is right. It matters. I'm old school enough.
Totally.
I'm sorry, it matters. And
we'll
see.
The buy the dip, though, coming back a little bit, and some of the names that have gotten most, just gotten a lot of attention recently. Not a lot of action today. I think people are exhausted. It's been a weird month.
It's been a weird month. It's been a weird after Labor Day start to the week, and it gets weirder next week. Stay with us next week for a huge news flow. I can't say enough about the news flow anticipated next week. And then we will be in London looking at the huge challenges post-ECB of what we'll see from the continent of Europe, and, of course, the unique challenges of the United Kingdom, including Harry Kane going to Bayern Munich. We're going to devote, I think it's Tuesday, we're going to devote the entire show to the exit of Harry Kane.
Can't wait.
To Germany. Right now, working with Ian Bremer at Eurasia Group is Anna Ashton, Director of China Corporate Affairs, on, of course, this relationship of U.S. and China. We need a brief this morning as well. And I'm going to cut to the chase. I see a lot of hysteria, and we've had some good voices calm us down a bit. Take us away from the immediate hysteria of China to clear thinking. How are you thinking clearly about the domestic challenges of China?
Well, Tom, it is quite a challenge to be the one who's supposed to come up with the positive take, because China really is facing some serious economic hurdles right now, and they're different from hurdles in the past. The slowdown is systemic. The real estate crisis is affecting lots of sectors, but at the same time, it is important to remember that while China may be growing at this present moment more slowly than the United States, which is odd, and it's still growing. And it is an enormous country that is also growing in population with a middle class that is set to grow. So there's a ton of opportunity that remains. I think one of the issues that is kind of separate from the slowdown, but also makes it harder and harder for foreign firms to do business successfully, and has nothing to do actually with regulations either, is just the fact that there's more competition in the Chinese market from domestic companies than there used to be.
If I look at the domestic companies, it comes back to the SOEs, the state-owned enterprises. Like the waves every 8 years, we're going to de-emphasize them, we're going to re-emphasize them, or that. What is the relationship of those state-owned enterprises now with the new Xi regime in Beijing?
Well, definitely Xi Jinping is more of a state sector man. He has definitely moved away from his predecessors in re-emphasizing the role of the state and in his, pretty firm belief that the state needs to be involved in directing which parts of China's economy are going to be emphasized and are supposed to grow. But interestingly, that seems to be the direction that U.S. politics is going to a lesser extent as well.
Anna, we had Pierre Ferragu on earlier, and he was saying that he wants to start it, or he wished he had started a hedge fund to buy every dip in some of the names that are most affected by the geopolitical headlines, in particular about U.S. and China relationships souring. Is this time different?
On the one hand, I would agree with him. How many times has there been a prediction that China was the coming collapse of China, that China had reached the end of its miracle of growth and development? But so I tend to err on the side of China will figure it out, because there have been all of these times in the past when we thought it was different too. But there are some serious differences here. A big one is that there's really no way for China to try to come in and bail out the economy and rescue growth with a huge stimulus the way it has done in the past, without reinflating the real estate bubble. And if they did come in with a stimulus, it wouldn't necessarily do what they truly need it to do, which is increase consumer and private sector confidence so that there's more consumption. And that really is a change.
Do you also think, Anna, that there needs to be, or that there will be, more of a response from the U.S. in light of the fact that the new development in the Chinese phone was released during the Commerce Secretary's visit to China? Gina Raimondo is there. The timing very much trying to thumb the nose at the U.S. government, and that there seems to be a much more direct tit for tat.
There's definitely a much more direct tit for tat. And, we've seen that play out in a number of different forums in the last few days. So there was Gina Raimondo's statement on Face the Nation about not necessarily wanting to apply the word trust to the relationship or improved trust after her visit, but saying, we really need to see action. And there was, sort of similar tone from Vice President Kamala Harris when she was at the ASEAN Summit and the East Asia Summit, talking about the need for China to not pursue these gray zone activities in the South China Sea. Sorry, go ahead.
Al, thank you, and I greatly appreciate it. Too short a visit today. Let's do it again. Somehow we will with China. So much in the news. Anna Ashton with us with the Abramowicz Eurasia Group. I'm going to bring this back to G20. I believe Justin Sink is on the plane with the president. We're going to see the president land here, I'm going to think, within 30 minutes nighttime in New Delhi. And, of course, all of our coverage there. I thought Manana was wonderful earlier this morning. I'm going to go to Dr. Bremer, working with Anna Ashton in his a wonderful effort, a G0 world. I wonder, is it a G0 G20 this time around? Because selected people aren't there. There's sort of this massive confusion. And, oh, yes, there's a war going on as well. I have no idea where we are on the backside of G20, or frankly, if it matters.
Well, and that's the communique that we've gotten some sort of indication that they've already drafted, talking about risks to long-term growth from cascading crises, which means basically, we don't know. We're worried, too. I mean, really, what kind of communique is this with any definitive response to what's going on? Unclear. The more interesting part of these meetings, to me, will be the side conversation. Saudi Arabia's Mohammed bin Salman with President Biden, the Prime Minister Modi with President Biden in terms of creating a closer tie there. Some of these sort of geopolitical fault lines where they start to emerge in a more concrete
form. And this goes back to Obama and the Pittsburgh meetings, where maybe they actually got something done a zillion years ago. But, the bottom line is I look at the G20 meeting less of a G0 effort than the G7 meetings or the G6 meetings. I think, as you say, these bilaterals that they have off to the side can be actually more interesting. And, you show up, the elite meet to greet to keep the dialogue going, which maybe right now is not the worst idea.
You think Tim Cook's going to show up? Be like, hey, just want to
chat
with you. He's G21. Exactly.
Yeah, I like that. We've coined that. Bramo gets a copyright on that, folks.
All right.
Tim Cook, Apple joined. That's the headline, folks. Apple joins G20 to make it G21.
Just to be clear, we have no confirmation of that. So if you think that, that's not.
It's speculation.
Is that?
Here
yeah, speculation
Bloomberg
from us.
News. Futures flat. Mohammed Al-Arian's writing it down. Make a note. Bramo says it's G21. Al-Arian in the next hour with Ferro. That'll be interesting. This is Bloomberg. G21 coverage.